Good morning, everybody, and welcome to today's Investors Expo Trading Summit with four great speakers, including myself. I'm always interested in doing these because it's in trading. What I'm going to talk about later today. Trading is a journey; it's not a destination. As traders, we always want to be improving ourselves. And what I'll be talking about specifically is strategic order flow, which in my mind is the pathway to trading success. Before I begin, I'll just go through a little quick disclaimer. Trading does involve risk. Risk capital is money that should only be used for trading, which you can afford to lose. Don't basically go out there try to think that you're going to, all of a sudden become a millionaire. The meme that I like to describe is, um, people buy crypto, all of a sudden, next thing they're expecting when they're going to get, their Lamborghini, and this is not how it works in the world. So what you're going to discover today is actually a couple of things. One, you're going to achieve market understanding through order flow, and two, I'm going to try and get you on the path to trading success. Trading is a difficult journey for a lot of people. A lot of people are always want to become traders, and they think that they open an account, they put money in it, they spend some money on a trading platform, that all of a sudden they're going to be making money. It doesn't work that way. It takes some effort on your part. It's going to take some learning on your part. And really what I want to happen today is for you to have sort of that light bulb moment where you're going to see, oh yeah, I could, by understanding what's happening in the market, I could become a better trader. And I'm going to show you how to see market activity that's invisible to most traders. Okay, so it's a combination. People say, is there a holy grail in trading? Well, there's not necessarily a holy grail in trading, but it's about understanding what's happening in the market and be able to discern things that other people just don't understand why it's happening. Okay, and that's really how you're going to become the best trader that you could. So this is for you if you are, whoops, basically if you're frustrated with the markets, where it feels like you can't do anything right, right? And it's like every time you get into a trade, it just seems to go against you. I mean, people like to joke around. Sometimes I joke around about it. Sometimes, like, every time I try to dip my toe into Bitcoin, I'll buy Bitcoin, then next thing I know, it drops because, I don't really understand that market. I'm just sort of buying it on the hype. But when it comes to trading the actual markets, the futures markets, the E-mini S&Ps, crude oil, the bunds, the bonds, euro currency, I know what I'm doing, and I've done it for a very long time. So, this training is really for someone that wants to be successful, but to be successful, you have to keep learning. Now, imagine if you could wave a magic wand around, right? You would take better trades. You could understand market structure. You can know which market activity matters. There's so much activity that happens in the market that a lot of it, everyone, you hear the term noise, right? There's a lot of noise in the market. Okay, what if you were able to understand to sort of take away that part that's the noise and focus and concentrate on the part that really matters, right? And that's where order flow is going to help you as a trader. Now, for those of you that are new to one of my presentations, again, my name is Michael Valtos, and why you should listen to me is because basically I've got a lot of experience, right? They say if you want to learn from somebody, you should learn from somebody that's done it, right? Walk, along with them, have them show you what works, what doesn't work. Well, I've got over 25 years as an institutional futures trader, experience trading at JP Morgan. I spent 8 years at JP Morgan. I spent 3 years at Commerce Bank. I spent 4 years at Cargill. I spent 3 years at Dean Witter, and I spent some time at EDF Man. And this job that I did was as a trader, right? I sat on the trading desk, banging out trades all day long, watching the dome, the depth of market. There wasn't footprint charts when I started. I started on the CME floor, and basically the only really type of order flow that we had was watching the orders come into the pit, listening to the volume of the trading pit. Was it getting louder? Was it getting softer? As the market was making a high. And eventually I left the trading floor when electronic trading started up, and I never looked back. I took to the electronic trading environment like a fish to water. Now, in 2013, I left my nice job at JP Morgan, and I just needed some time away from the market, time to recharge. And then I started writing a book called Trading Order Flow, okay, which was there was no books on trading order flow at all out there. And I sat down, I started writing this book, and at the same time, of course, I'm trading for myself, but I realized the software that was out there was very basic, right? So that's why I developed my own software to make reading the order flow easier. Because at the end of the day, order flow is not a trading system. Okay, what it does is it organizes the data so that you, the trader, can make better trades. You could understand where there's market strength, where there's market weakness, where buying's being facilitated, or trading is being facilitated, where there's weak highs or weak lows, or if there's a strong high or strong low, meaning the market's going to keep going higher. There's just so much to order flow that I thought, hey, you know what, it'd be nice if I had some software that could actually help me see this a lot easier, rather than me sort of trying to discern it. Sort of I sat down and I coded up a lot of rules that would translate into the software, because trading with software, it's binary, right? It's zeros and ones. So, you have to be very specific on it. And, that was eye-opening for me. But since then, I've worked with hundreds of retail traders to improve their trading. In the past, when I worked at, places like JP Morgan, everyone was, a superstar. We used to call the term that was used back there was, high flyers, because everyone was very good. You didn't have to sort of go through a training program or anything like that. Everyone was already successful in their own rights. And then when I started working with retail traders, I understood where people were suffering um, in their trading, whether it was from making bad decisions, or the psychology of trading, or simply reading the market incorrectly. So that's why I like to do these presentations, is just sort of get it out there so people can understand what's happening in the market. Now, like I said, I created software, right? It's called the Order Flows Trader software, and this is what people have been saying about it. Michael, your Order Flows trading software is remarkably helpful, because I can clearly see now what's really happening in the market, like, for example, who's in control of the market on a very specific time, and who is getting weaker as well. Okay, so there's been a lot of great positive feedback in the market. Now, people say, "Oh, Mike, if you've been such a good trader, all those years, why are you teaching this? Why don't you just trade for yourself?" Yeah, I do, but in life, it's about giving back, right? What good is the information if you're not willing to share it? I've been a big believer in each one teach one, pass the information on, because at the end of the day, what good is knowing all this information about trading if I'm hoarding it, right? The way I look at it is, there's enough food for everyone, right? I want everyone to eat. And if you can't get your own food right now, you can eat off my plate. There's this misconception that people have, that's like, oh, I know how to trade, but I can't tell you, how I trade, because yeah, you might take away my edge. Well, there's so many different ways of trading the market and being successful in the market, that there's room for everybody up there at the top, right? It's not like one person goes up into, the level of profitability, and that means someone gets knocked down. No, it doesn't work that way. There's plenty of space for everybody up there, and that's why I like to, come on Investors Expo, is to share this information with other traders. Now, what you're going to discover today, get on the path to trading success, right? Which is really, what we all want to do, right? We all want to be successful traders. I want you to achieve market understanding through order flow, and I want you to see market activity that's invisible to most traders, teach you how to see that. Okay, so achieving market understanding through order flow. Now, understanding order flow will make you understand market conditions. Now, once you understand market conditions, that's going to keep you on the right side of the market, and being on the right side of the market will improve your trading results. All right, so this is an order flow footprint chart. Okay, and at first it looks daunting to people. There's a lot of numbers up there. Oh my gosh, I don't know what to do with this. This is too confusing. People just sort of write it off right away. I know, my kids are like this. Sometimes I show them something and it looks confusing. They don't even want to attempt to understand it, and I try to teach them, try to understand it first because it's to make your life easier. And in order flow, right, there's so much information you're going to see on a chart. You're going to see the volume that's traded on the bid, the volume that's traded on the offer. You're going to see the point in a bar that has the most volume. That's called the point of control. You're going to see what the difference is between the aggressive buyers and aggressive sellers in a bar, and that's called the delta. Now, why is that important? Is because, even though there's volume on the bid side, there's volume on the offer side. For a trade to occur, someone has to cross the bid offer line. Someone has to go from working a bid to lifting the offer for a trade to happen, or someone working an offer has to sell into the bid for a trade to happen. And that's not something that a lot of people really understand. For every trade, there's an aggressor. Okay, somebody that actually went and said, you know what, I want to buy this or I want to sell this right now at the market price. Now there's bids and offers always working in the market. That's in the limit order book, which provides liquidity in the market, but that can be manipulated, right? Bids and offers can be entered, can be pulled, and not trade. Whereas when there's actual trading occurs, that's really what you want to focus on. And that's really the core of the order flow. You know, back in the old days, I say the old days, 100 years ago, right? When, one of the greatest books on trading, Reminiscence of a Stock Operator, about Jesse Livermore, he was a tape reader, right? We've all seen those old pictures from the 1920s, where the traders are sitting around the stockbroker's office and there's like that vacuum tube with the ticker tape, right? And people would be looking at the trades. Well, they weren't looking at the limit order book in there. They were looking at the actual trades that happened, right? Because that's really what matters. That's the commitment of a trader to the market, right? Now, so you have delta, you have point of control, right? Delta is the difference between aggressive buyers and aggressive sellers in the market. Point of control is simply the price level in the bar with the most volume. Then you have imbalances, right? Markets trade in a two-way auction. You have a bid, you have an offer. So if there's more that's trading on the offer by a certain ratio versus what traded on the bid, that would be called an imbalance, a buying imbalance. A selling imbalance would be the opposite, when you have more transactions happening on the bid side versus the offer side. Why? Is because it's showing which side is more aggressive. And there's a ratio that most people use, which is 4-to-1. You don't have to use 4-to-1. I know a lot of people that use 3-to-1, you could actually use like 2.5-to-1. I know some people that like to use 10-to-1. It's sort of the industry standard, and a good starting point for most traders is 4-to-1, right? And you can see those are going to be the numbers in a bar that's blue, right? So you can see here 3 against 56, 44 against 178. These are imbalances greater than 4-to-1, buying imbalances. Now, selling imbalances are the opposite, right? So you have 2 against 15, 30 against 153. These are selling imbalances. So you have more aggressive selling at this price in the two-way auction versus buying at the other price in the two-way auction. And that's important to know because that's going to help you keep on the right side of the market most of the time. Because really, what you want to do is you want to be trading on the side of the flow of money. And if the flow of money that's coming into the market is strong to the sell side, why would you want to be buying? If all the orders that are coming into the market are sell orders, sell, sell, sell. If you're trying to buy, you get into a new position trying to buy, well, don't, you'd be fighting that stream of sell orders, and ultimately you're just going to get stopped out. Now, order flow differs from the normal bar chart, right? This is the normal bar chart, okay, candlestick chart. And a lot of people say, well, the candlestick chart's got so much information. What information? All it's got is the open, the high, the low, the close, right? I mean, it's colorful, which is nice. It's easy on the eyes as opposed to a normal bar chart, but it's just showing you where price was. You don't know where the heavy volume was in a bar, and depending on sometimes where the volume appears, it could be very indicative of what's going to happen next in the market. So, imagine if you have, at the top of this bar, heavy selling, Then down here, you got heavy buying and the market came back up. And then when it comes back up, that heavy selling that was here earlier is no longer there. You know that it's a green light to just go higher. That's where order flow is going to help you, right? It's going to help you understand the market conditions. Now, traders are accustomed to just using indicators. There's nothing wrong with indicators. I create indicators, but the indicators I create are based off of market internals, what's actually being traded in the market as opposed to the price. And by say, what I mean by what's actually trading, I mean, the volume that's traded on the bid, the volume that's traded on the offer, whether there's buying imbalances, selling imbalances, where the buying occurred in a bar, where the buying or selling occurred in context of the market structure. Now, if you're just looking at a normal bar chart, you're not getting any of that information, right? You're just seeing where the open, high, the low, the close was in the bar, and whether the bar opened and closed higher, or whether the bar opened and closed lower. And what traders like to do is they like to try and simplify things. Okay, that's why they create indicators. And the problem with price-based indicators is, one, you're treating all prices the same, and not all prices that trade should be treated the same, because at some prices you could have heavier volume, some prices you could have very, very light volume, and other prices is probably just going to be your normal volume. A lot of people say, oh, I got chopped up today in the markets, or the markets, there's a lot of noise in the markets. Well, when you're just using an indicator based on simple price analysis, basically you're making an indicator based on noise. If you're saying, most of what happens in the market is noise, and you're just putting an indicator on noise. But if you're putting an indicator based on what's actually being traded in terms of volume, in terms of um, the two-way auction, in terms of balance, in terms of imbalance, in terms of aggressive buying or aggressive selling, of passive buying, of passive selling, you're really going to understand the market conditions a lot more. Because remember, you should be trading market conditions, not price, right? People say, well, no, price is the most important thing because that's what gets people to buy or to sell. Well, price is really, something that people are going to make their decision on. But what you should be doing is, is the market moving higher or moving lower? Now, it's one thing to look at price. So yeah, price goes, price ticks higher, market's going higher, just buy it. Market ticks down, just sell it. Well, it doesn't go that direction forever. You can see that there's times where the market just sort of goes sideways, goes up, then just goes sideways, goes up, then finally sells off. What, as a trader, what you want to know is, all this stuff here, it's probably noise. All this stuff here is probably noise. But if you get to a point where it's like, okay, maybe all this buying is done. And once the buying is done and you're up at the high of the day, this is yesterday, the market is ripe for a sell-off, right? I mean, we hit a high earlier here, market just went sideways, made a new high, market went sideways. You made a new high, but then the market sold off. And as a trader, you want to be looking for those clues as to why the market is selling off, and position yourself to be short in this case, right? Because you're watching the market condition, you're not necessarily watching price, because you just made a new high, okay, I should be buying. Just made a new high, okay, great, I should be buying. You made a new high, yeah, sure, I'll buy some more. But if you were to buy up here, next thing you know, the market dropped 10 points, almost 20 points within 5-10 minutes, right? You're going to get loss after loss after loss if you think that way. I mean, you might have some small wins, but your losses are going to be very, very big. Now, again, being on the right side of the market is about being long when the market goes up, short when the market goes down, and more importantly, out of the market when the market isn't doing much of anything. Really, what you want to do is you want to be able to understand, right? People say, oh, you got to be in sync with the market. Yeah, you do. There's a lot of times where the market isn't doing much of anything. It's just basically rotating around, going sideways. Okay, fine. Just leave it at that, right? Let the market facilitate trade. That's what the markets do. But if there's a clear sign that the market is getting ready to sell off, that's when you get short, right? If the market is going higher, that's when you want to be long. But not just because, oh, we made a new high, now I'm going to try and buy a breakout, because, the market can go higher, but to where, right? We don't know where it's going to go higher. If you just indiscriminately buying breakouts. But if you're at the high of the day and everything all of a sudden turns bearish, what you're seeing in here, all right, you can see you got selling imbalances. Oh, sorry, you've got negative delta in here getting stronger, minus 300, minus 600, minus 685. You know, that's a sign that's telling you, you know what, this market is ripe for a sell-off, right? You're getting lower point of control, lower point of control, lower point of control. You have volume migrating lower, right? Which is telling you that as volume migrates lower, value is most likely migrating lower because you know the fair price, which is what value is, the fair price of each bar is going down, right? That's a bearish sign. You know, imagine what it is basically like, you know, if you've ever run a business and you know, you're selling, you know, pens or whatever, and you know the average price of a pen is, you know, $2 and you're doing good business, then all of a sudden business starts getting slow, you know, you got to start lowering your price, right? And that's really, you know, if I were to rename the point of control something else, I'd just call it the price tag, right? Oh, I know the price tag of the market at this time is 46.96. Now I know it in this time it's 46.92. Now it's, you know, 46.91 and a half. So I know prices going down, right? I know that there's supply in the market, you know, that, you know, people are happy to try and lower their price to sell it, right? Just as if the market was going up, people, you know, you're going to see point of controls generally go higher, 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 you know, higher, higher, higher until it stops and it starts coming down. So that's, you know, be on the right side of the market. Okay, so that's all well and good, but you know what? How can I tell that in the order flow? Well, you want to see market activity that's invisible to other traders, right? Because basically, if if basically order flow is information, okay, and information is valuable to the trader, right? We all, you know, the big, you know, we hear the government numbers that come out every day, almost, you know, CPI, PPI, GDP, the employment numbers. That's information, right? And information is so valuable, you know, people go to jail over it, right? But that's called insider information. Order flow is not insider information. Order flow basically allows you to see what's happening in the market, right? The actual trading that's going on in the market. This information that's currently available to you. You know, if you have a real-time data feed, you know, from your broker, whether it's like CQG Continuum is the most common one, this information is available for you. You just have to have a tool that is going to help you analyze it. So for example, this is the E-minis, okay? If you're just sitting here watching the market, the market just sort of came down, just sort of going sideways, then it rallied, right? It rallied about 15 points in, you know, in about 10 minutes, right? Those are the moves that as a trader, you want to take. But the problem is, oftentimes by the time people realize that this market is going up, they've already missed half the move. But if you're watching the order flow, you can sort of see what's happening, right? And this box here where the market is just going sideways on, that's just sideways activity, right? That's the noise that everyone talks about. It's not until you have this bar here that's very actionable, right? We sort of come down, test the lows, rally up, come up and close on the highs. All right, people say, well, yeah, that's so obvious. Well, and then by the time they realize it, they're getting long up here and they just got such a small trade. But if you're watching this bar form, you're already getting signs in here that the buying is getting stronger, right? Not only that, but if you sort of walk it back a little bit, you can see here, right, you had some very strong selling come down here, minus 1,035. Then you go inside, minus 122, still inside of this bar here, plus 238. And then minus 369, minus 94, plus 37, plus 86, then boom, plus 530. So you're sort of just hanging inside of this big, strong selling bar, right? Minus 1,000 in the delta, just going inside, inside, inside. But delta is, the selling is gone, right? This was it. This is the big push down. This is it. We're going lower. Everyone's coming in and selling it. Everyone came in, had negative delta of 1,000. But then no follow through in 1, 2, 3, 4, 5, 6 bars. And not only that, you know, the only big negative delta minus 369 couldn't even move the market lower, right? So then The delta is getting small in here. It's just, small delta is minus 94 plus 37 plus 86, then boom, plus 530. But what else do you have, right? So you got delta getting stronger, positive. So, aggressive buyers are here. You have, three positive deltas, but you've got selling imbalances in here. This is a green candle, right? You got one, two, three selling imbalances. Then you got buying imbalances after you're closing, you're going up. So it's telling you that you have aggressive selling in here, but it's being absorbed by passive buyers, right? People are happy to just sit here and bid the market, right? Yeah, sure. We just sold off, but now you're seeing signs of strong bidding happening in the market. Actually, there were signs here earlier in this bar here at 917. It had negative delta of 369, but it was a green bar. So what it's telling you is you got negative delta on this green candle is because you have strong passive buying in here. You've got the 264, you got the 492. Now, these are not imbalances in the two-way auction, but this is what's causing that negative delta. When you have negative delta in a bar that turns green, generally that's a sign of absorption because what is happening is you have aggressive sellers selling into the bid, but you have a strong buyer there absorbing all that selling. So this was the first sign. And then you're seeing the little signs of life coming in here with the positive deltas, 37.86. But then this bar is more obvious. You do have the imbalances, the 66 against 379, the 33 against 167. Right, then the market shot back up, and by the time it got towards the upper end of this bar, people that were selling down here now become the buyers up here, right? Buying it because they realize, we're not going lower, we're going higher. So that tells you now is the time to be getting in. So you'd be getting in around 32, and market just shot up to 42 within 1, 2, 3, 4, 5, 6 minutes. That's a six bars right there. So that's how order flow is going to get you into a trade as soon as possible. You got a moving average. It sort of comes down here, slopes down, and it's coming in here maybe around the 36. People say, well, we just broke the moving average to the upside. They get long at 36, they ride it up to 42, thinking it's going to go up, and it just comes right back down, and then they get stopped out. Now, seeing what other traders can't see. Now, here's a market. This is E-minis. Again, market's rallying up, quite strong rally. All right, that's what you like to see. Point of control is mostly going higher, but as you're going up, you get up to this point where you got strong delta 486, 346, but then 64. You'd be wondering, well, we're going up, but what's happening? The aggressive buying is getting weaker. That's not a good sign of a market that's going to go up and up and up, right? If you expect this market to keep going up, you want to see delta, being steady or growing in a positive sense, not negative sense, going down 486, 346, and 64. Then you got negative delta 108, negative 108. It's like, okay, we just made a new high. Now we're looking at basically negative delta, and the preceding bars, the aggressive buying is getting weaker. Well, what's that telling you? It's telling you that, you know what, this move is probably over, right? And then again, you're looking at another 10-point drop in basically 5 minutes. Now you're also seeing selling imbalances here on the way back down, 50 against 0. Nobody traded. No one was interested in working an offer up in here, or so rather buying this offer up in here. Instead, everyone is just looking for the exit door. Get me out, sell 50, 87, 65, 101, 192. Even in here, people, just, get me out, work an offer. I don't care. This is their limit offer right there. Market comes back up, trades back up to that point where there was that first imbalance. And then again, same thing, more selling imbalances, and the market dropped from 34, right down to 24, pretty much, not say straight line, but a nice 45-degree line down. But you could see the signs, what's happening in the delta. Rather than delta getting stronger, it's getting weaker as the market is making its new high, or swing high in this case. Right? So imagine you're going up, you're making a swing high, but the buying is getting weaker. What do you think is going to happen? Well, if buying is getting weaker as you're going into a swing high, there's not much buying power left. And once that buying power is removed from the market, what's left is for the market to go back down. So you can see here, right? This is Monday in the E-minis, right? We had this low here, 46.62 3/4, just sort of hanging around the low, hitting it, bounce, made a new low by a tick, made another new low by a tick before, boom, it finally started rallying. Okay, here you sort of had a little half-hearted rally, came back down, tested that low, then shot back up. Now, this is a lot of information in here. Okay, so imagine, right? Sort of follow up on what I just said. You're coming into the low, you're seeing the negative deltas, which is what you expect to see coming into lows, right? You expect to see selling, right? Then over here you get a bit of buying, right? Positive delta 800. That's a good bullish sign. Then here you get positive delta of just 28, then negative delta. It comes back down, tests the low, and then it shoots up. Right? It doesn't look back at all like it did earlier. So what's the difference of what happened in here versus what happened in here? Well, there's a number of things. Okay, so first you had your nice positive delta here. You within a tick off the low here at 62.5. It sort of went sideways, shot up. You got your higher point of controls. You got your green candles. This bar here, you got some negative delta, minus 46, and positive 800, and then just 28. A market's not going to really rally very much on a very small positive delta, especially if it's trying to come up off the low of the day. If it's coming up off the low of the day, think of it like, blowing a balloon, right? You want the balloon to rise. Well, you got to put, strong blows into the balloon, right? Strong, into the balloon. Otherwise, if you just do a small one, it's not going to inflate very much, right? And that's sort of what this 28 is, right? It's kind of a neutral delta in a sense, right? What you want to see, 806, that's good. That's very good. Nothing wrong with that. Here you're seeing 54, then 448, 200. Then you got a little, the inhale part, you got to take another breath, and 60, okay. It's not the strongest, then 400, 100, right? But more importantly, now you're starting to see, imbalances as well, right? You're getting the higher point of controls. These three bars, these three green bars, very similar to these three green bars, right? Higher point of control in these three, 1, 2, 3. You've got some buying imbalances. This one's got 4 buying imbalances. This one's only got 2. This one's got 2. But the delta is stronger, right? It doesn't look like much, but it's a shade stronger. 448 and 222. Sort of this bar was sort of like the push, like, okay, yeah, let's just sort of pile in and let's go get it higher. They couldn't get it higher. And there was nobody else buying at this time that was really willing to take it higher. You have these imbalances, the 315 against 26, the 54 against 10. But what happened is basically someone just came in and said, not on my watch, and started selling these bids here, the 54, the 315, the 286, and pushed it back down. Once that seller was done, then, very similar. The other thing that you have here is what's called a divergence. That's this little green arrow, right? You have positive delta on a new low, which is a bullish sign, right? Anytime you have delta divergence, right? A positive delta at a new or equal low, or negative delta at a new or equal high, that's what's called divergence. But you also have in here something in the order flow called an order flow ratio, which is telling you basically there's some stopping volume coming in down here at the low, right? Which is also bullish. So you didn't have any of that earlier, the divergence. You didn't have, the stopping volume didn't come in until now. And now the delta is a bit more consistent. The point of controls are a bit more, the point of controls are going higher, and you have the imbalances. So there's a little bit more for you to work with buying this low. Buying this in here, okay, you can. I don't think you would have been stopped out, because you wouldn't have been stopped out until the market made a new low. You would have just taken quite a bit of heat before the market went up and started going in your favor. But these 3 bars is very similar to these 3 bars, but these 3 bars has a little bit more to it, right? With the ratio, with the divergence. Now, this is something that I've been teaching since I released my software, is the ratio and divergence trade, which is, great trades, because sometimes the market can go from the low all the way up to new highs, or from the highs down to the lows and continue making new lows. So this is, one of my bread and butter trades, the ratio and divergence. Now, another reason you want to use order flows keep you out of that chop, right? Remember what I said, a lot of traders complain about, oh, the market's so choppy, I can't do anything. That's where order flow is going to help you. If you're seeing a lot of small deltas, basically that's telling you trade is being facilitated. The aggressive buyers and the aggressive sellers are pretty equal. They're happy to facilitate trade at these prices. You're seeing point of controls sort of not really going anywhere, maybe one or two up, one or two down, sideways more or less aligned. You're getting bars with point of controls at the same levels or, within a tick of each other. These are all signs of sideways markets, okay, which is, those are the markets you want to stay out of. Again, something similar. It's about seeing things other traders don't see. And it doesn't have to be as complicated as I just showed you. You could focus on one thing in the order flow. This is crude oil yesterday, right? We had this nice jump from 69.70 all the way up into, above $70. Well, what's the sign? Just as over here, we're trading 69.90 and we sold all the way down to 69.60 before rallying again. You know, Say, Mike, what's the easiest thing to get me started? Well, concentrate on imbalances. Look for the bars that have multiple buying imbalances or multiple selling imbalances, right? Because that's where the money flow is coming into the market, right? That's what you want to be trading as following as a trader is where the money is coming into the market. Because if you're looking at this chart right here, right, you can see these three bars here, or this bar here has got 1, 2, 3 buying imbalances, 1, 2, 3 selling imbalances, right? That's going to keep you on the right side of the market, being where the imbalances, positioning yourself with the flow of money is going to help you. Where is this? This is yesterday. Would you be selling here? Up here at the top. We just made new highs. This, remember, right? The Fed announcement came out and basically he said stocks to the moon. We're going to keep printing money. So markets reacted as you would expect, right? Markets lifting all these heavy offers: 2,000 here, 1,200 here, 1,300 here, 2,000 here. But then it just goes sideways in here. And then all of a sudden now you're up here at the highs of the day, right? At this time, again, we did make higher highs later. But at this point, people are realizing, this market's overextended itself, right? And then it came in big selling here, right? A couple of ticks off the high, you've got very strong negative delta. Okay, maybe maybe people are taking some profits. We just had that big run up, and then it just sort of goes sideways, sideways. And then again, we're still up here near the high. And then you're seeing the selling come in over 1, 2, 3 bars. You're seeing multiple selling imbalances, two selling imbalances here, three here, three here, lower point of controls, 1, 2, 3, 4. Okay, maybe this move up is over for now, right? And you get short, somewhere around the 40-ish area, and it trades immediately down over the next couple of bars to 30. So, that's how you're gonna be able to see things that other traders, if other traders are just looking at a bar chart, they're not seeing this interaction between buyers and sellers out there, right? They're just seeing, oh, the bar closed up, the bar closed down. Okay, that's it. So I want you to get on the path to trading success. Well, how do you get on the path is basically never stop learning, right? You'll never know as much as you should know in trading. That's just the way it is, okay? So again, never stop learning. Anytime the market is at a high, you want to be understanding, should I get short here? Is it possible for me to get short here? And by reading the order flow, you can say, you can put two and two together now. You can say, okay, well, I just made this new high, but just earlier, I made that new high, we popped up, should I be buying this breakout or not? Well, earlier we're sitting here, you see all negative deltas in here, all negative, right? Then it sort of pops up here. You got some small deltas, 2, 14, but then 2 again. Then big selling comes in this bar, minus 56. Obviously, you got the imbalances. That's not a good sign when you're at the high of the day to see aggressive selling come in, to see negative delta. And, you could have got a quick, what is that, 15, 20 ticks over the next couple of minutes, right? Just as if your market is going sideways, you want to be looking for something that's actionable, something that I could wrap my head around and take this trade, right? Market is sort of coming down in, and then it just takes off. right? Well, what's the signs? Okay, so you're coming down in here, you got negative deltas. Okay, market's selling off. I got some selling imbalances. Then you just sort of got these three bars in here, positive delta, positive delta, positive delta. All of a sudden you see one, two, three buying imbalances. Okay, you're not seeing selling imbalances anymore. You're seeing the aggressive buying come in. That's your cue. Get long, right? Remember, trade smarter, not harder, right? Make your life easier. Use the power of computers to help you make sense of what's happening in the order flow. This is a chart I was showing you earlier about the imbalances. What if you had software that's going to say, hey, show me the bars that have multiple buying imbalances, well, or selling imbalances. So here you go. You had a swing high, multiple selling imbalances, just off a swing low, multiple buying imbalances. Doesn't get much easier than that. Right? If that's one thing you can take away that. Now remember, trading is a journey, not a destination. There's always curves in the road, so prepare yourself the best you can. So what you need to get started, never stop learning, learn from a professional, and get the proper software to make market analysis easier. So far you discover how order flow puts you on the path to trading success in a field that many people fail in. You can achieve market understanding through order flow, which allows you to trade with more confidence and conviction, and how to see market activity that's invisible to most traders that you can capitalize on because you have information very, very few traders have access to. So I hope you get this one thing. When you understand what's happening in the market, you put yourself in a position to become a better trader. Order flow gives you an edge by presenting what's happening in the market in an easy to understand format. So how do you make this happen? Well, you got two choices. You could do trial and error over a year and then come back and listen to another presentation of mine, or you can get results quickly. So what I've got for you is the order flows trader software. Now, this is not for everybody, right? It's not for people that are looking for a red light, green light trading system, or people that think they know everything, or people that don't want to put in any effort, right? What you're going to receive is the order flows trader software, which is the volume footprint chart with 17 pre-programmed order flow indicators. You get started in minutes. It's very easy to use. It works on NinjaTrader 8, and I sell this on my website for $8.99. Now you're going to also get access to weekly live training, right? Which I show you real order flow examples, live training on ways to use order flow, and get your questions answered. This is included, right? Normally people charge $200, $300 a month for access to this. Over a course of a year, that's about $2,500. But you're going to get that for free. But I got extra bonuses for you, right? I'm going to give you my order flow trading course, which is valued at $297, right? I sell it for $297 on my website every day. I'm going to also give you access to the Order Flows Inner Circle video series, which is on my website for sale at $497. So the software, $899, the group training, per year is $2,500. The trading courses, $297, $497, that's over $4,000. You're not going to pay that today. But what you're going to do is you go to orderflows.com/off3. There's no monthly payments. It's only $749, right? That's all you got to do. And as a special bonus, I got a special bonus for Investors Expo's traders. Is you're going to get access to the order flow playbook, which is a course I did, which, learn how to use order flow to trade around market structure, learn how to use order flow to see market strength and weakness, and learn order flow trade setups. I sell this for $297. So with all that in there, you're going to get all that stuff for just $749. It's a one-time payment. There's no monthly payments, right? I hate that stuff, monthly payments, because sometimes you forget to pay your credit card bill, then it doesn't go through, then it's like, oh, you get headaches, right? Now, I told you earlier, I wrote a book on order flow trading. If you're interested in my book, you just go to orderflows.com/book, and you just enter your name and email, and that will take you to the download page on how to get it after you enter your name and email. Now, I do realize, we're getting short on time. So to get started, what you have to do is, again, just go to orderflowstrader.com/oft3.html. The link is in the chat below. I think Anna's put it in there. So again, thanks everybody for taking the time out of your day. Anna, I'll throw it back to you. So thanks for having me. And let's put the link back up there on the screen. So everyone, if you're interested to get started, go to orderflows.com/oft3.html. And I hope to see you guys on the inside.
All right, so First of all, welcome again, everyone here today. Thank you for participating in this event. Thank you for sticking around and listening to me present here today. I'm going to go through some stuff fairly quickly. I'm not here to sell you anything today. Just want to go through some information and share with you what we call our market maker level training system. Like I said, I'm not going to sell you anything here today. I do have an offer for you to come check us out here at the end of this. So if you stick around, you'll be able to get that as well. But like I said, not trying to sell you anything here today. All right, market maker levels, the secret trading levels of a veteran floor trader. I'm not a huge fan of these kind of marketing gimmicks, which the secret or the inside story or those kinds of things. I put that on here, however, because it really is tells a story. I had the good fortune of having a couple of careers in my life, and in both of these careers, I had a mentor. In my trading career, I had a floor trading mentor. And the reason that I call this the secret trading levels is as we were going through this and he was kind of teaching me stuff and these kinds of things, he was really close to the vest in terms of wanting to share the nitty gritty of what I'm going to show you here today. And so as we began to trade together, I would always come in and say, where are the secret levels today? Because he wouldn't tell me, again, the specifics of these levels. And so it kind of became this running joke. So that's why the title is Secret Trading Levels of a Veteran Floor Trader, because it took him a bit of time to warm up to me and feel comfortable sharing the information with me. He retired, and I am going to share with you today some of this information as well. All right. So what am I going to show you today? I'm going to show you how to change the paradigm by increasing your reward to risk ratio by up to 300% using a few simple tools. So again, we all know this, right? The 1-to-1 reward to risk ratio required to break even is 50%. It actually is a little bit more than that when you start factoring in slippage and commissions. A 2-to-1 reward to risk, your break even ratio becomes 33%. Again, a little bit more when you start factoring in slippage and commissions, and a 3-to-1 reward to risk, you need to be at about 25%. You're in the right place today. If you're an active trader who is looking for a proven way to increase your reward to risk ratio, you're tired of seeing several days worth of profits erased by one bad trade or one bad trading day. Also, if you are interested in learning more about these levels that were used by this veteran futures floor trader in his everyday trading. So I'm going to give you a quick introduction. This is me back in 1988 when I graduated from the U.S. Navy boot camp in the Great Lakes Naval Station. We called it Great Mistakes at the time. I am a combat veteran of Operation Desert Storm, and I held a top secret security clearance while I was in the Navy. A few short years later, that's me. Again, I took, after I got out of the Navy, I attended school, took an entry-level job in a travel call center. 11 years later, I'd become the VP of that same call center. I was laid off after 9/11 and started day trading full time, and I am celebrating our 11th year here as a trade room moderator and day trading educator here. Again, we just went through our 11th year here at Trade with OTG. Now, getting here hasn't been easy. In fact, it's been hard. I spent over $30,000 purchasing training programs and trading education that didn't solve the one recurring issue, and that was consistency in my trading. And I almost quit trading entirely. It wasn't until I was able to change my paradigm and learn how to cut the losing trades short and let the winning trades run. We all hear that all the time, right? Cut those losing trades short, let the winning trades run. It wasn't until I was able to get to that point. In fact, in our trade room today, and I'll show you a little bit about how that went today. But in our trade room today, we had one of our room members actually say, you know what, Jason, it must take years of practice to be able to do that. And it does. It takes time. It's not a simple solution. What we try to do here is shorten that learning curve, right? With what I'm going to show you here today. All right, before we get started, Uncle Sam wants me to let you know that the CFTC wants you to know that options trading and future trading has large potential rewards, but also large potential risk. You should seek appropriate advice from your broker or licensed investment advisor before taking any action. Trade with OTG does not hold itself out as a commodity trading advisor. So given this representation, all information and material provided by us to you here today is for educational purposes only It should not be considered specific investment advice. And if you wanted to get the full risk disclaimer, tradewithotg.com/risk-disclosures. So what I am going to show you today, does it actually work, right? That's the question everybody has. Okay, so that sounds great, but does it actually work? And so what you see here is a screenshot of the Top Step Trader website. They're called just Top Step today. But back in 2018, they funded 1,020 traders, and the fastest time to fund a trader, and this was posted on their website, was 15 trading days. That was done by me. You look here at this YouTube video. This is a webinar that I ran, how I passed the Top Step Trader $50,000 trading combine in 15 days, right? And so again, that was done by me back in 2018. Now, again, that's not the only successful trading combine that I have taken in the past. This is just a fraction of those that we have done. And again, the couple things that I want you to notice here is that the total win percentage here was about 45% was the average win rate, right? So I showed you reward to risk ratio. When you are cutting your losing trades short and letting your winning trades run, you are going to have a lower winning percentage. But again, you aren't, as a trader, you aren't being paid on your winning percentage. You're being paid on your bottom line, right? And so the average winning trade during this run was $421. The average losing trade was $119 for about a 3.5 to 1 reward to risk ratio. The other thing that you'll notice here is, again, we talk about cutting the losing trade short. You'll notice here that the average winning trade roughly four times longer holding on to the winning trades than we are the losing trades. Now, back in October of 2020, we went through in our trading room, we went through a Top Step Trader trading combine. And what you're looking at here is the letter that Top Step Trader sends out when you pass one of their trading evaluations here. It says, congratulations on reaching the funded level. Hi, Jason. Congratulations on passing the trading combine and reaching the funded level. And that's an example of the letter that they send out to you when you when you pass. Now, they give you a couple of different options, and I'm not here to talk about which one is the best in great detail, but I will tell you that going the direction of the pro account, if you are in one of these Top Step Trader funded programs, going the direction of the pro account is a better option than going the direction of the funded account. And again, I'm not going to talk in great detail about that, but this box that I have circled in red here, it says that once your account in the pro account, which by the way is a simulated account, so you are technically being funded in a simulated environment. And once that account reaches $5,000, they will take that live money and put it into a real trading account. Or if you so desired, you could take 100% of that profit and move on down the road. But again, what they are doing here is they're giving you that simulated account, which is why I think it's a better route for you to go. If you get slippage in positive slippage, which you don't get in live markets, but you do get in the simulator, they're going to pay you for that. Again, you have that less pressure of being in a live market in a simulated environment while you're earning live money. Anyway, that's the pro account. And so once you go into that pro account, and once you pass that and you achieve that $5,000, they're going to move that money into a premium funded account. And once that happens, this is the letter that you receive. Congratulations, you've earned a premium funded account. We're thrilled that you've reached a significant milestone in your trading journey. And you'll notice here where it says we will transfer to your pro account the balance of your premium funded account up to for futures $5,000 and up to $2,500 for the micro. So again, this is that letter that you receive when you do hit that $5,000 mark. Now, it's not just Top Step Trader that I've gone through and was successfully able to pass. We've also done one with Earn to Trade. I also completed a webinar that says how we went from start to a $5,000 deposit in my experience with a proprietary trading firm. Now, I'm going to try to zoom in here without freezing up my machine. But what you can see here is this is a little bit blurry, I guess, but this is a screenshot of the bank account here where they deposited $5,000 from Earn to Trade. Now, I don't know if you can see that clearly or not, but that's what that represents there. All right. And again, I'm going a little bit quicker here today. We have 45 minutes and I want to make sure we get everything covered. We're again, so just if you're just joining us here, we're going through the process here of kind of talking about is what I'm going to show you today. Does it actually work? All right, here is a clearer shot of that bank account information where they deposited the $5,000 into my account from Earn to Trade. All right, so it's not just me that does this. This is one of our customers that joined us here. His name is Stephen G. This is an email that he sent me. He said, by the way, I passed the first step on phase 1 with Top Step with your trading methodology during my free trial over the past 4 days. If that wasn't worth every penny, I don't know what is. Obviously, Steve became a member, and this was an email that he sent. He made $6,196 in his Top Step Trader trading account during his free trial. All right, so we have over 400 plus trade videos on the website. I'm going to throw a link to that here into the main chat area. You can take a look at this at your convenience. There is a link to the YouTube channel where we literally have 400 plus videos. In fact, let me bring this down here so you can see this. There are literally 400 plus videos where I go through the trade room and showing you exactly the type of trades and using the levels that we're talking about here today. Here's a $3,100 NQ trade. Here's a $1,000 NQ trade. This is a 19 and a quarter point NQ trade. And this one says market maker level. So you're going to be able to go through there and check out some of those videos that you see there on the screen. All right, so the market maker level training program that we teach is all about the process. So from a high level perspective, the market is always telling you a story, right? It's our job to figure out what the context of the market is. Once you've determined the context of the market, then what is the structure? And that's what we're going to talk to you here about today. The market maker levels provide structure in the market. Once you've gone through that, you've got your strategies to execute. Then you have your tactics, and then you have your risk management. And this circular kind of motion is the process that we go through on an everyday basis in our live day trading chat room. Now, what are the market maker levels? Well, as you know, the market is continuously telling a story. The story provides the context for the daily trading session. The market maker levels are the structure points inside of that daily story. So the way I look at it is the market is a book, and the structure points are the chapters within that book. It's our job to then go and figure out the strategies that we're going to implement on a day, and then the tactics that we're going to use. And I'm going to show you some of that here in just a couple of minutes. Once determined, these structure points are used as tactical areas to make trading decisions, entries, stops, and target locations. Why do these levels work? I get asked this all the time. Why do these levels work? Well, as you know, the markets do not move linearly in nature. The markets will rally and pull back and then pull back and rally. Statistics will show that the market will be non-trending greater than 80% of the time. So here is a market profile of about 2 weeks worth of trading. So the market sold off and then it rallied. Then it sold off and then it rallied. And then it sold off and then it rallied. And then it sold off and rallied. These levels work because they are taking that information from previous sessions and then projecting forward the structure points for the next trading session. So again, in order to fully understand why the market rotates, you must understand the auction process and how markets go about discovering what the fair prices are in any given day. Remember, the market moves from horizontal development to vertical development to horizontal development and so on, right? The sole purpose of the market is price discovery. The market will rotate within a range of prices until a variable changes that causes the market to rally to find sellers and sell off to find buyers. So one of the examples that I like to use is, let's say you're buying a piece of real estate. And I live here locally here in the Dallas-Fort Worth area, and we had a basketball player here that played for the Mavericks named Dirk Nowitzki. Dirk was driving through a neighborhood, found a house that he liked, wasn't for sale, got out, knocked on the door. I'm Dirk Nowitzki. Wow, that's cool. Knocking at my door. Wanted to buy this person's house. He paid 30% over market, as the story goes. Now, when it's time to sell properties in that neighborhood, That is a one-off, right? That was a one-off idea that happened. The market is not going to consistently go to that new price. That was a one-off event. However, if in that same neighborhood it was discovered that there was nuclear waste in the water or some kind of contamination in the water, then all of a sudden the prices in that neighborhood would drop significantly until they found a place where the buyers said, okay, I'm going to step in, and it's now worth the time and money to spend to clean that up. So the property's values would go down until they found buyers. Conversely, if they found a rich oil deposit underneath those same properties, then the market would rally until there was no longer any meat on the bone, and the sellers would start to step in and try to liquidate. And that's what the market does here on an everyday, day in and day out basis. Now, these levels work because these rotations create a set of measurements that are based upon time and price cycles from previous trading sessions. What you see here on the chart to the right, and I'm going to go through some live charts here from today's session. What you see on these charts to the right is an actual way that these levels perform in the market, similar to stairs on a ladder, right? The market will go down, find a level of support, pull back, find another level of support. In this example, rally, pull back, rally, etc. in those same type of rotations. These measurements are then, like we said, from these previous sessions, are projected forward and become the structure point for the day's trading session. Now, again, I get asked this question a ton. Jason, are these floor trader pivots? And the simple answer is no. And while both sets of these levels were developed and used by floor traders, there are some stark differences in how price is measured and the levels are calculated. Standard floor trader pivots go like this. You have your pivot point. That is kind of your center line, right? That takes the high, the low, and the close from the previous day session and divides that by 3. That becomes your pivot or your main center point. The R1, resistance 1, and resistance 2 are a variation of those levels. The R2 and R3, the S2 and S3 are variations of that as well. These measurements are basic in nature and do not take into consideration changes in market and price volatility or range expansion as it is occurring in real time. The market maker levels, which I'm going to show you here today, these calculations are based upon measurements which derive from time and price movement. Because of the time calculation involved, these levels evolve in real time to account for the changes in rotation and price discovery. There are 3 measurements that we talk about. There's the ETH, or extended trading hours session, which is kind of the bigger picture idea. Then you have the RTH, or the regular trading hours, which form right at the pit open based on previous price from the overnight session. And then you have the intraday trading session levels that occur as well. So I've kind of gone through that very quickly, and that was the point here. I've got about 25 minutes. I want to spend some time going through some of these charts here with you in today's trading environment that occurred here in real time. So let me grab this, slide it out of the way. Whoops, close that. Okay, so we're going to talk here. We'll start here with the NQ. That's kind of my new favorite instrument. You'll notice that we had a couple of nice NQ trades up here today. This is the P&L it was as it occurred today in the live day trading chat room. And again, let's take a look here. So these are the overnight structure points. We call these the ETH, or the overnight. They're kind of the bigger picture levels here. Now, what I'm going to show you today, I'm not going to recommend necessarily that you trade these this way, but I am going to show you, because we all do this, right? We all come in and we say, well, what would have happened if I would have gone short at the level or long at the level, et cetera? So let's just take a look here. Now, again, there is some context that needs to go on in this discussion. And so one of the context points is that when the market opened up today, the market had spent the majority of the overnight session above settlement. And so one of the things that we talked about as we got into this today is that the market was either going to move away very quickly. We had the FOMC yesterday, and that caused the market to rally. Market is going to move away very quickly, or it's going to come down into settlement. And if we break settlement, then you are going to be looking short. And that's exactly what we were doing in the trade room here today. So I'm going to turn on what we call the zone of influence. Now, as you know, the market support and resistance is less about Support and resistance is less about, hang on one second here, is less about to the tick precision and more about zones of influence. So what I'm going to show you here is what the zones of influence that we use here on the NQ. And give me a second here. I don't think I have that set properly. Let's see here. Yes, I need to do this. Okay, create that zone of influence here. Okay, so you'll notice that the market rallied all the way into just into that zone of influence up here, right, in the pre-market session, right? Market sells off into this ETH signal, bounces, sells off again all the way down into this ETH mid. Now let's say you were waiting for it to actually hit this area, remembering what the context or structure of the market is, right? And we talk about reward to risk ratios. So let's say that the market sells off here, you breaks down, comes in, and you decided you wanted to get short here, okay? Well, my stop here would have been the ETH signal 16,246. I would have been at 61, right about here. Okay, we're gonna wing it here, right? So that's 61 ticks. That's about 15 points, right, on the NQ. Now the market breaks down. That would have stopped. Yeah, breaks down, pulls back right here. Okay, pulls back into this zone of influence where you would have looked to gotten short, and you write it down to this level down here. That is 859 ticks, right? So 859 ticks divided by 61, that is a 14-to-1 reward to risk ratio. How many stops can you take if you got a 14-to-1 reward to risk ratio, right? You could take a number of stops, right? And that's the point of these levels and why they work the way they do. So what I'm going to do here is we're going to turn the overnight structure points off, and we're going to turn on the day structure points and say, okay, let's take a look at what happened here on the day structure points, right? So the market opens up, comes in, finds a little bit of support here at the RTH signal, rallies, pulls back, and breaks this level here. And we did this, a little bit of this in the room today. So I'm going to go here. Whoops, I don't want that. I want the drawing tool here. I want to get to the ruler, right? Market, again, we're looking short today because the market was trying to push down into settlement. In fact, settlement today on the NQ was 16,286 quarter. Let me put that on here so you can see here, 16,286 quarter. Let's see, I'm looking for the horizontal line, 16,286 quarter. Okay, right here. All right, this will be close enough. You'll get the idea, right? So that's the settlement price, right? Market comes down and tests settlement, pulls back up and rallies, and then breaks right there, right? So you broke your level, you broke settlement, you pulled back into settlement a little bit, and this is an entry, right? Right in this area here, off of these levels. Now, you break here, you pull back. Let's say when you break this level here, you use the sell stop, and I do this a little bit here, or you could have waited here until you get into that zone of influence. Either one. I don't have the zone of influence turned off here, but that would have been the zone of influence right in this area right here. So let's say you took it on the pullback here, right? So this rolls down into that level there. That is 229 ticks on the NQ, 229 divided by 4. That is a 57-point NQ move, right? Market pops into that level, rallies back, bounces off, right? And so again, this is just giving you the structure points. But again, as you can see here, the market kind of adheres to these structure points. You broke through, and you don't have any of the RTH session levels here any longer. So again, this is where your overnight structure points would come in, and you can see how the market rotates around that. That is today's NQ. That's today's NQ look. Let's take a look at the previous day. Okay, so this is let's take a look here at the pre-FOMC, right? Market opens up, does not close below the RTH mid, comes down exactly to the level below, pops back up, right? And you can see here, I had a drawing here and said I wanted this market to close here below this line, comes down, stabs right into the RTH target below, rallies up, rotates, rallies up almost to the tick at the RTH mid, and then has the big sell-off before the FOMC meeting minutes. And then of course the market rallies aggressively after the FOMC. And let's take a look here. We're going to turn off the day levels and turn on the overnight structure points, and look what happened here, right? Structure point to structure point to structure point, slam down into it here. This is right at the release of that FOMC. Big, huge candle right here, stabs right into the ETH signal, rallies, 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 and closes the day right at the top of this ETH target, right? And so the point of that is this. These levels provide excellent structure points in a market, right? And even if you take a stop, right? You take a couple of stop outs here, right? You jump back on board here. Let's say this is a good example here. Okay, let's say market pulls back. You wanted to get long here at this level, and you took a 15-point stop. That's 933 to would be what 33, 23, 18, right? Your stop would have been right about here. Okay, that would, let's just call that the stop right here. Well, the market breaks back up, pulls back into this level, and you wanted to get long again, right? Because you made lower highs, or sorry, you made higher highs and higher lows and higher highs. You pulled in right here, and you rode it all the way to this level up here as an opportunity. That's 1,301 ticks. So you had a 60 tick stop and a 1,300 tick opportunity. That's a reward to risk ratio of 22 points, right? That's a reward to risk ratio of 22 points. You can be wrong a lot and still be right with the 22-point reward to risk ratio. Even if you took it off at that level, that's 658 ticks. That's a 10-to-1 reward to risk, right? Okay, so that's what the NQ looks like. You kind of get the gist. Let's take a look here at what the ES has done in today's session. Market opens up here at the RTH mid. Again, same kind of idea, settlement here. The market had opened, settlement today on the ES was 47 half, 47.00 half. So we go here to the horizontal line, and settlement was right, let's see, 47.00 half, which is right there. We call it right there. So we knew that the market had spent, there is the low, the market had spent the vast majority of the time, just a little bit of time back here above, right around settlement, and spent the majority of the time of the overnight session. I would call this about 98% of the overnight structure was above settlement. Remember context. So what we say is the market's going to come down into settlement. If it doesn't open and immediately start to rally away from settlement, it's going to come down and check it. So again, the opportunity would have been short here on the ES. You take your ruler, right? And you say, look, I'm going to get short here at 47.20 quarter. The stop would have been 30 quarter, 23 quarter. You might have been taken out. Let's see, this pulls down, goes through, pulls back up into it. Would you have been taken out? That is the question here. Might have been taken out. We probably need to break this down into a 1-minute chart to see exactly how this played out. So let's do this. Yeah, that's your 1-minute spike right into that. So you would have been taken out there. The question is, would you have been able to get back in here? But let's assume for a minute that you weren't. You're still looking short around settlement here. Okay. So let's call that a stop out right there. Well, now you had this pullback into this area, and the market comes down into the low here. Would have given you an opportunity for 35 ticks. That's 8 points. You had a 3-point stop and an 8-point opportunity down at the low. Market pulls back, bounces, rallies, comes back into the low, and pulls back into this level here. Okay. So again, let's say you took another stop here, right? Say you played this area and you took another stop. So you're down, let's say you broke even here and you're down 3 points. You're down 6 points, right? So the market pulls back, comes down into the low, and you said, look, this is getting structure here. This is a high, lower high, lower high, lower high. And again, we're just kind of going through this as not even using any other filters or any other indicator or type ideas. The market comes down into the RTH target, and that is 75 NQ points. If you rode this from the signal to the target, 75 divided by 4 is 18 points. You've taken 6 points worth of loss. That's a 3-to-1 reward to risk ratio. 6 points worth of loss, 18 points with the target. That's a 3-to-1 reward to risk ratio. You can be right. You can be wrong a lot with a 3-to-1 reward to risk ratio. And that is just in today's ES. Let's back this up just a little bit here and take a look at yesterday on the RTH sessions levels. So again, this is the FOMC day. And what you see here in this, what you see is this, this was the value area from yesterday's trading session. I like to put that on the chart, yesterday's RTH session. And let's take a look here, right? So this is, okay, we're going to come here. All right. So on this particular day, the market opens up into the RTH mid and like stairs on a ladder, rotates down to the next level, rallies down to the next level, rotates to the next level above, right? Like stairs on a ladder until you get into that FOMC, right? And this is where this would get interesting. So here is your FOMC. Let's get into that here. Whoops, this is a 1 minute. I need to go back to the 5 minute here so we can not quite so aggressive here on the moves. There we go, like this. Okay, so here is your FOMC meeting minute structure. Okay, so on a very volatile, crazy day, like the FOMC day is, market comes down into the ETH signal, rallies a little bit. You get that bar at the FOMC, it comes down, stabs the RTH signal, rallies, rotates, rallies to the next level, ends the day up at the ETH target, right? That is on a very wild and woolly FOMC meeting minute day. And if you took that trade, there was 391 points of opportunity. Again, you don't have to get all the points out of that. That's 97 that's 97, that's 391 ticks or 97, almost 98 points worth of opportunity at these levels. And again, we're not using any filters here. We're not using a moving average or a volume weighted average price or some other filter that you might use, order flow like Michael was talking about earlier. These are just looking at the levels as structure points on your chart that then help you make a decision from a tactical standpoint, right? And again, why do these levels work? Because they are measuring previous session price rotation and then projecting those price rotations into the next day's trading session, right? And so it's taking real-time market information from the previous session and moving it forward into this day's trading session and giving you these structure points. And that's one of the reasons why they're so accurate. And remember where they came from as well. They came from a professional floor trader, a guy who traded on the floor for 30 years. And that's where this information is derived. All right, same thing here. We'll take a look here. This is an overnight structure point on the prior day on the ES. Market opens up and really just finds support at the first level, rallies, finds support, rallies. Then you get here into the overnight structure, gives you one opportunity to get in, ETH signal, all the way down to the ETH target, right? And again, this opportunity here, if you trade at this time, and there's some international folks that may trade at that time, there may be some US folks that trade at that time, that's 4 in the morning. That's 109 points of opportunity down to this level right here. 109 points, 109 ticks, that's 25 points, so 26 points-ish, right? Down to that area, into your overnight. The market opens up on this particular day, right? Opens up here, comes all the way up into this level, stabs that level. Let's say you tried to get short here and you took a stop right here. Market comes up. Now you start using a little bit of your filters, right? Let's take a look at, let's grab a rectangle here, right? This would make a lot of sense, right? This would make a lot of sense right here. So do you think you're going to find some resistance in that area? Probably, right? There's a lot of price action in that area. Resistance right at the structure bid, a place to look to get short. You took a 3-point stop here, let's say. Took a 3-point stop. You have an opportunity to go from this level to this level down below. That's 86 ticks. 86 ticks divided by 4 is a 21 points. That's a 7-to-1 reward to risk ratio right here, right? And so the point is that there is an opportunity for reward to risk, right? When I talk to traders that come into our trade room for the first couple of times, they're nervous about a trade. So they take one off at 10 ticks and they let the other one run, or they take one off at 1 point and they let the other one run. And by the other one running, that usually means 2 points or 3 points, right? I'm an all in and all out trader. And I have a whole other webinar where I show you exactly why a 35% win rate on one lot is better than a 60% win rate when you're trading two lots, taking one off, right? Statistically, mathematically, I show you why that opportunity is the opportunity to hold on for these bigger targets is better. Intellectually, we know that, but it's a hard thing to do sometimes psychologically. All right, so that's what the ES looks like. Let's take a look at the CL here today, and I'll give you a chance to take a free trial here with us. Okay, so the market opens up, pulls back right into this level here, gives you a chance to get safe, rotates around this level, comes down, could not make a new low, breaks this level here, goes into the zone of influence of the level above, and where does it stop? On a dime at the RTH signal, and then pulls up to the level above. And then again, it's trying to get into that RTH upper target. And this is today's environment, right? I'm not cherry picking these. This is what's happening in real time here today. So the market opens up, and let's say that you were going to get long here, right? It rallies up for 35 ticks, but you're holding on for this level above, so it takes you out here at break even, okay? Market pulls back, comes into this area here, and you said, well, I'm just going to get short because I'm just going to take it short, long, right? That's 17 ticks. I have a 12 tick stop on the CL. You would have been stopped out. Market comes in, breaks this area here. You wouldn't have been able to get in because you wanted to play the pullback. Market comes back, plays it here right into this level, as takes you to this level above. That is 54 ticks, right? 54 divided by 17. So one stop for 17 ticks, one winner for 54 ticks is a 3-to-1 reward to risk ratio. Remember what I was telling you earlier as we went through this, right? And I showed you all of these successful combines that we've taken in the past. My average win rate was 45%. My reward to risk ratio was 3.5-to-1, right? And that's exactly what we're talking about here. Stops are okay, right? As long as you're getting out and you're not moving the stop because you understand what the structure is, and then the market rallies, gives you a chance for those bigger opportunities. Let's take a look at the day before. This is an inventory report day. Let's take a look at that. Take a look at the inventory report day. It's going to be choppy. I have a feeling here. I don't remember off the top of my head what it was like yesterday, but okay. So where is the number? Okay, right here is the inventory number. So let's say you set on your hands right here because it is inventory day, and boom, right here at the inventory number. The inventory number on the CL. If you're not familiar with that, that is a very, very volatile kind of opportunity and an idea. Market comes down, finds support at this RTH signal, rallies to the level above. That's 52 ticks with the 12-point stop or 12 tick stop that never would have even come close to getting hit, right? Rallies into the ETH session open, pulls back, right? Rallies again. Then you get to the FOMC meeting minutes, and look how it just rotates around these different levels here on a day in and day out type basis, right? And ends the day up at this RTH target location above, right? All right, so that kind of gives you a flavor for what it is that we look at on a day in and day out basis with these market maker levels. Like I said, I'm not going to look to sell you anything here today. All I'm going to do is invite you to come in and take a free trial with us, right? If you want to come in and sit in our chat room with us, you're more than welcome to do that. I'm going to throw the link in here for you right now. Register for that, come in, sit with us. We start at 8:15 every morning, and then we go through kind of the context and the analysis and all of those different kinds of things, and then you could come in and watch us trade here. Okay, let's see here. Let's see, if the market closed bullish on the bear move, would you exit? The market closes bullish on a bear move. Yeah, it depends, right? Structure is the structure points. It depends on what time frame you're looking at, right? I have guys, if you're trading a 30-second chart, that's a much different look than a 5-minute chart. If you're looking at 15-minute chart, that's a much different look than the 1 minute. That's a really complicated question, so I don't mean to not answer the question. It's just Yes, I'm looking at those levels. I rely upon those levels to give me structure points in the market. So I don't know if I've answered that question or not, but that's kind of the way I would look. It's kind of interesting here as we sit here. I'm going to turn off these zones of influence just because it makes the chart a little muddy. I turn this off here, and we're going to look at these NQ levels here really quickly. All right, I'm going to turn these off here for a second. By the way, this is a NinjaTrader 8 indicator. Turn that off, and we're going to do this. And again, you can kind of see how, like steps on a ladder, the market rotates through these different structure points, right? Okay. What are the formula to calculate these, Vic? If you come in and you end up becoming a member of the group, I'm not only going to give you an indicator, I'm going to teach you how to draw them, and I'm going to teach you the math behind why we draw them. This is kind of an interesting question. The reason I do that, it's not a very smart business decision necessarily to teach you the exact reasons why, and not the reasons, but the drawing of the actual level itself, the calculations. A lot of folks out there just give you the indicator because they want to protect that. The reason I teach you how to draw it and to teach you what the whys behind the whats are is, let's be honest here, right? Is that when NinjaTrader 10 comes out, whenever that is, if that vendor that you've relied upon with that indicator goes out of business or is no longer trading or whatever the case may be, that indicator that you relied upon is no longer available or valid, right? You can't get it anymore. But by learning the math behind it, you've done a couple of things. One is, if I ever go away, you know how to draw it. And the second reason is that it's important for you to understand the math. It's important for you to understand why something works. Like, remember in grade school, they taught you a formula and you had to do it by hand, and then they eventually gave you the calculator, right? But you didn't get to use the calculator until you actually got to understand the why behind the what and what the formula actually was. The points do change every day. They're based on previous day's price and time cycle rotations. They do change on a day in and day out basis. ETH stands for extended trading hours, Larry. RTH stands for regular trading hours. So you'll notice here where it says pit open, this is the beginning of the regular trading hour session. So if I turn off the overnight structure points and turn off the pit open levels, these are the levels that form right at the pit open and are valid through that entire session. We also have intraday levels that form as well based on the price and time rotation on after the open, right? So after the RTH session, you get a set of levels that form up in real time as well, right? So again, these are based on time and price rotations and cycles. What are the ETH open and close times, Vic? The ETH open is right at the pit close of the previous day. So if you'll notice here, pit close, right? The next set of levels form up here on the ETH, and then of course they form up on the RTH side of the equation right at the pit open. And let's see, sorry if closed on the opposite side. Sorry if it is closed on the opposite side of the entry. Gosh, trader, I am so sorry. I'm not understanding the question. Do me a favor. I'm going to put my email address in here and send me an email, jason@mailotg.com. I'd be happy to discuss it with you. I'm just not sure I understand what you're asking me. And with that being said, I'm about 30 seconds away from turning it back over to Anna. So before I dismount here, I'd like to say this. Thank you for joining me here today. I appreciate the time. I know Anna appreciates the time, and I know the other speakers do as well. And so again, thank you very much for allowing me to spend 45 minutes with you here talking about what we do. I encourage you to come in, sign up for a free trial, and hope to see you in the trade room and with.
I'm Norman Hallett. That was Anna, who faithfully puts together, I really believe, some of the best speakers around. Jason, and following me is AJ Brown, who I'm a huge fan of. So when I'm done, please do stick around. I approach the market a little bit differently. My firm does offer what we call simple trading plans, but really my focus is helping traders with the lost art of sticking to their trading plan. Most trading plans actually work fairly well if they fit you as an individual, and we're going to go through some of that right here. But I wanted to zoom in today on the real reason most traders lose and how to fix it. Let's get right into it, because I'm kind of squeezing a 1 hour talk into 45 minutes, which is always good. Another reason I like to speak here with Anna, because you really can't, as I said in my email to my list, inviting him here, you can't do much of the fluff stuff. You got to get right into it. So let's get into it. Here's what we're going to do in my 45 minutes. I'm going to first discuss who's going to benefit from this talk, why you would want to even listen to me, what I'm going to promise you in this short period of time. Then I'm going to really get into why the question of, do 90% of traders really lose, or is it a myth? I mean, is there proof? And if all of the losing is true, why do we still go out there and try to trade, especially if all we've done to this point is lose? Why do we keep going at it? And what's the answer really to all of this losing that continues to happen with 90% of the traders? Of course, if that figure is true, and if you want my help on how to turn all that around, if you're part of that 90% that's struggling, I've got something for you that's a little bit different that I think you're really going to like. So let's get into it. Who will benefit? The trader who spends most of their time in stress mode, the trader who continues to keep blowing out accounts. You know, I did a poll one time with the traders that had first come to my list for the free stuff, and asked how many traders actually blew out one account, two accounts, three or more, or five or more. And it amazed me that about 40%, and I ran this several times over the last 15 years, and the numbers are very consistent. About 35 to 40% have actually blown out five or more accounts by the time they come to me and want to approach the mental and emotional capabilities that they have, turn some of those weaknesses to strength. And a full 70% that come to me have blown out at least three accounts. And you know, you don't have to do that to qualify to work with me, because really the mental game of trading is really the key for most people to get straight. The trader who sweats through rooting for a trade, I call that rooting, where you put on your trade, and from then on in, all you're doing is kind of rooting that your stop doesn't get hit, and when it almost gets hit and it backs off, and you get out at break even only to see it make money if you had stayed in. The trader who continues to sweat through their trades every day, probably based on, you know, some of the emotions that they developed previously. And the break-even trader who understands, and most of the people that I've worked with in this category are professionals who have a certain degree of control, but have one or two issues that's causing them to go sideways in their equity, literally trading for years and getting nowhere. These people who value their time feel that that's the worst thing that happened. A lot of them say to me, gosh, I wish I would just blow out my account so that I can get onto something that I'm good at, but instead I keep on wasting more and more time and getting nowhere as fast. If you fit into any of these categories, let's talk. So who's going to benefit? To be clear, it's going to be futures traders, forex traders, stock traders, and options traders. Anybody who trades really anything that moves and that you have a risk involved in. Or we even help bond traders over the years, day traders, swing traders, even position traders, who sometimes come to me kind of last and say, well, I didn't know I don't try to trade every day or every week, but when I do have to make a decision, you know, somehow my emotional components get in the way and I can't seem to think straight. I do the wrong thing. So if you're any of these people, and if you're here listening to me now, you probably are, and that's okay, because there is a solution. Why listen to me? I've written several books. A few of them have been on running and managing effective trading plans, designing and constructing. And I think this particular book is still published, as well as this one. This is one I did for about 4 years straight, what I called 4-minute drill for traders. If you search for 4-minute drill for traders, you'll see some 4-minute inspirational, 4-minute right at between the eyes kinds of talks that I gave every weekend for 4 years, every Saturday to my list. And somebody said, you know, you should take some of the snippets from those from your talks and put them in a book. Well, somebody did it, and that's this book. It's kind of more of a coffee table inspirational book. Most traders who buy this, they just kind of flip blindly, open it up, and read something that they feel may be inspirational to them. This is something I still think this is on Amazon also. This is actually a video. I talk frequently for the expos, the trading expos, and this was just a filming of that where I talked to a crowd kind of lively on stage. I think that's why they did that. And there's a picture of me doing actually one of those 4-minute drills. So I've been around. I've worked for Payne Weber. I've run one of the largest option firms in the country back in the 80s. So I've been around traders and trading mentality for a long time. And because I play in the area of the mental and emotional issues of traders, I've partnered with a lot of the people that you probably know. Hubert Centers, who used to be the partner of this person, this third person here, John Carter. They used to be partners. They're not anymore, and they're both doing very well on their own. The guy in the middle there, of course, he calls himself Mr. Candlestick. That is Steve Nissen, who I've partnered with many times, as well as John Person, who, if you've ever gone to any of the expos, he's one of the main attractions there. All of these people were at my event a few years back, the Disciplined Trader, where they talked about juxtapositioning what they do with the importance of what we do with the mental and emotional issues. So if you're a person that believes that if you want to see the kind of direction you're heading in, just kind of take a look at the people you hang around with. These are some of the people that I hang around with. Okay, what is my promise for you today? I'm going to show you exactly why 90% of traders lose, but I won't leave you there. I'll show you several studies from around the world that prove that what you've always heard, 90% of traders lose, is true. And I'm going to show you exactly why trading firms de-emphasize this truth and emphasize instead the dream of riches. And I'm going to show you how you can end the losing and frustration, turn the tables on the industry, and start trading successfully in 2022. It's a mouthful, but you'll have no more making needless trading mistakes that result in huge drawdowns, no more sitting there tensely rooting for your position like that sweaty guy, but instead you'll have confidence in your outcomes and no doubting that being a trader is really right for you, because your results will finally be able to prove that you can do this. You know, many traders who come to me, especially for our one-on-one coaching, they at some point, there was a point at which they said to themselves, I don't even, you know, I don't know why I'm even doing this. I don't know if this is for me. They take a few weeks off or months off, and then they decide one more time, I'm going to give it a try, but I'm going to work with the mental and emotional things that are stopping me because I have a pretty good trading plan. This is the promise that I'm going to make to you today. So let's get into the proof. Do 90% of traders really lose? There is this is 4 studies that I've shown 3 or 4 of these, but at least 2 or 3 of these before in past talks. But it's not easy to find these studies because trading firms, what they do is they go into transactional firms and they ask for their paperwork. They can kind of black out the names and the account numbers, but they want to see the results. And most trading firms don't want to get into that. So it's very hard for even regulatory firms, unless they force the issue, of which one of these studies was kind of forced. But when you do find them, they seem to reveal pretty much the same thing. This is a study from the North American Securities Administration Association. 100 years ago, a small group of state securities regulators had a big idea: form a network of colleagues to work together for the protection of investors through North America. Today, that group is made up of securities regulators in the United States, Canada, Mexico, so North America. Together, they call themselves the North American Securities Administration. This is their motto from their site. And I'm going to show you what they found out in their study. I'm also going to show you a similar study in Europe. This is the one that was kind of forced. They demanded that transactional firms turn over. Oh, I'm sorry. They did not demand in this study. What they did was they asked for volunteers in this particular study to volunteer to be part of the study, and they got a lot of people that did contribute. I'm going to show you a graph of what happened there. Then I'm going to show you a specific country, Spain, who really takes risk and advertising credibility in high regard. And I'm going to show you, based on their study of looking into transactional firms, kind of forcing themselves in, they passed a law, and I'm going to show you what that law is. Again, National Securities Market Commission, the body responsible for supervision and inspection of Spanish securities markets. And then I'm going to show you what I think is probably the most revealing study of all, although it gets the least traction and it's the hardest to find. It's if you're South American, or especially from your Brazil, you know Fernando, you know Rodrigo, and you know Bruno. These guys are very well known as some of the top traders in Brazil. They did a study that's very revealing. So let's get into quickly what those studies are. Here's the first study, North American study. This was done in 1999, so this is 22 years ago. And let's get right to the bottom here. It concluded that 70% of public traders will not only lose, but will almost certainly lose everything they invest. Okay, so 70% lose everything. Then they went on to say that further, 11.5% of the sample evidenced the ability to conduct profitable short-term trading. So this alludes to the fact that 88.5% of people are not evidenced with the ability to conduct profitable trading, but they say only 70% almost loses everything. There's a difference here of, what is that, 17.5% or 18.5%? And what's happening to those people? Well, I figure they're either breaking even or they're losing a little and not everything, but I wouldn't call them withers. So here's a study right here for most of you here who are in North America. This is one that reflects an 88.5% losing situation by people right here in North America. This is the European study, a little bit more recent. It was done almost 4 years ago now, and you can see they requested the transactional data from these firms, and what you see here is a pretty good. I mean, you're seeing 63% winners, 76% winners. This looks pretty good until you see the second page of it, where it starts to get into some of the firms that are not doing well. This one has 86% winners. Now, these are voluntary. The average was 76.3% of traders lose. So now here's one that was 23.7% win for traders, for firms that voluntarily gave their records to the government. And so this is probably the high end of the truth. I'd like to kind of wish they were required to give all of their records. This is a Spanish law that was created. There was a commission that looked over some of the what they called speculative. But the CFDs are anything that's bought and offset, stocks, futures, anything that you buy is forex, buy and sell. What first thing they did was binary options were outlawed when they took a look at the results. Okay, but they also passed a law based. This is the law that they based. They said that if you're going to advertise anything, any CFDs, any offsetting speculative investments, you've got to put in this disclaimer, and you must in bold put in between 74 and 89% of retail investor accounts lose money when trading CFDs. And if you want it an abbreviated, you can cut out most of this other stuff, but you can't cut out the bold 74 to 89%. I'm going to go more with the, you know, this is just my experience, and I think probably your experience out there. This is probably closer to the 89 than 74. But let's take a look at this is the Brazilian study. This was done most recently, a year and a half ago. Okay, and what they did was they discovered. Now, this is the second biggest trading market in the world, Brazilian market. Okay, equity market, and they found that 90% of all investors who persisted for more than 300 days, which shows you how credible this is, probably this study, because they don't want people that got in and out. They wanted people who were really trying to trade and make a living out of it or be serious with it. Found that 90% of investors who persisted for more than 300 days lost money. They all lost money. And only 1% earned more than the Brazilian minimum wage, which is roughly equivalent to about, I think it's equivalent to about $15,000 to $20,000 a year. And only 0.5% earned more than the salary of a bank teller, which is about $50,000 a year in US dollars, and all with great risk. So you're sweating the whole time you're losing, and even if you win, you're probably sweating. I think we can conclude, at least I have concluded, that it is likely that the secret whispering of 90% of traders lose money is a true statement. And here are some, and I didn't just cherry pick these. I've given you where to look for them and given you the titles. You look at them yourself and you can search for yourself. You'll find just what I found. First of all, they're hard to find. And second of all, when you do find them, they have results like this. Okay, so now that we have proven that 90% of traders really lose, why is trading so popular? Why is it so popular? Okay, and I'm going to give you three reasons. The first reason is there's very little regulation when it comes to advertising. I mean, when I mentioned that I ran a large option firm in the 80s, and it's really no different now. There's actually some tighter regulations then in some cases, but my office as the regional vice president was right next to the attorney who we had to pass all of our advertising through him. And you know, as long as we put words like "this can be you" and show, you know, somebody that made $1 zillion, or it's possible to 10x your money this year. And of course it's possible, but it's not probable. But you don't have to say it's not probable. All you have to say it's not possible. And as long as you put the boilerplate in there, trading futures can be risky. Only risk capital should be used. Past performance is not indicative of future results. You know, I can say it in my sleep, like one of those car salesmen at the end. As long as you put in the boilerplate, because people have the right to lose their money if they want. I guess people have the right to go in there unaware of some of the things that are against them. They have the obligation and the capability to look around and see, kind of dig into the reason why they keep losing if they're doing it over and over again. But it's not up to the advertiser. Their job is to make money for who they're advertising for. Either it's an outside firm that's advertising, or it's the firm doing it themselves. But there's very little regulation. In fact, the CFTC would never even approve any of the ads that we put out. All they would do would say, go ahead and run it. And if we got blowback from it, then they would say, hey, you got to stop running it. It doesn't meet our, they would never approve. And I believe they still do not approve. And I haven't run any ads in that respect, specifically through them, but I'm sure it's the same thing now. Okay, so, you know, nobody's taking responsibility for what you need to do, and that's understand the risks. Okay, reason number two is the trading system or plan and the trader, him or herself, they don't match. They're two different things, okay? And just like the mismatch here, some of the promised results from a trading plan that you see advertised to you and has a one-size-fits-all kind of a mentality when it's pitched to you is just as mismatched as what we have here. That one size fits all attitude is not going to work. And people have different personalities. I'm slightly ADD. I've never been diagnosed, but I know that I talk fast. People always tell me to slow down. And I know that I like the action when I trade. So I like a trading plan and a trading system that gives me a trigger or triggers that can keep me in the market more than out of the market. When I'm out of the market, I believe somehow I'm missing something a little bit in the way back of my mind. And so I've learned to respect who I am and the way I am naturally. It's easier to embellish and emphasize your strengths than it is to try to turn around your weakness. You're better off numbing your weaknesses and accentuating your strengths. So I would look around in my case, or case of anybody that I would interview, and I can find that they have that kind of personality that likes the action and so on. They'd rather be in a trade managing it than waiting around for trade to happen, and that's okay. There are plenty of trading plans that take care of that. But if you try to have a trading plan that, say, my accountant has, now my accountant, he needs to see this hoop jump, he needs to see volume, he needs to see a couple moving averages pass, he needs to see momentum there, he needs to see the price action, he needs to see 6 or 7 things before he'll even make a move. I could never run a system like that. Is he successful? Yes, he is pretty successful with his trading, pretty darn consistent for a guy that's trading while he's working. And the reason is because he has matched the system that he trades with who he is as an individual. So for all of these trading gurus out there that tell you they have the right thing for you, don't believe it. Don't believe that. You can believe that they have a great system, but don't believe necessarily that it's right for you, especially if you're the guy or woman on the right with the yellow socks and the that's okay for some of us older guys here in Florida, but for most of you people out there, I am actually wearing that exact shoe on that Converse right there. Wow, I'm wearing that today. I should prove that to you. But yes. And the third reason is the industry is complicit in what I call the hopping game. The hopping game is the silence that gurus and the industry has that trading discipline is just as important, if not more important, than the trading plan. There are many trading plans that you could probably be, as long as they fit you as an individual, that you can be successful with. Number of approaches you can take that make sense to you, as long as they fit you as a personality. But if you don't have the mental and emotional capacity, capability, strength to run that plan, I don't care what plan you think fits you, you're going to keep blowing out accounts. And there is a silence among the industry that propagates the losing. Because in the end, if you think about it, the more you lose, the more you go to the next guru for the answer. And in fact, when I first started concentrating on helping traders with their mental emotional issues, I was working with golfers and tennis players and so on, athletes mostly. Tisha and I, my wife, who's half of what we do, really the mental training part of what we do. It was a very working with them really shows that we as traders are athletes, and we need to see ourselves as athletes, and we need to emphasize that to ourselves and understand that, because athletes train their minds, and we are trading athletes. We need to train our minds to stick to our trading plans, because you know, if we have a trading plan that works and we can follow it, we can do well. But that's somehow not happening for you. So, but the hopping game, the fact when I first started, it was interesting to me that a forex guru would advertise the trading plan of another forex guru. Why was that? And the reason is because they know very well that a lot of the people most of the people who have bought their system are not winning. They're not winning because it didn't fit, not because the trading plan wasn't good for them, but somehow it didn't fit. They weren't motivated, or the individual trader may have had some responsibility, but they know that they can make another commission by referring to another forex trader and grabbing a 20 or 30 or 40% commission. So there was a hopping game going on. It's complicit. I am not saying that the industry is against you. They're not. Everybody that I know, all the pictures that I've shown you, everybody it's Jason or AJ or anybody. These guys are great people, and they're warm and they're fuzzy people who want you to win. But they also know that that, as I know, that most people who buy trading systems don't win. Okay, and so you need to, you know, the jig is up here, as they say. You have to juxtaposition yourself the way you know, so that you know who you are, and then make it happen for yourself. Okay, so what's the answer with all this losing? Okay, the bottom line is the ball is now in your court. Okay, the ball is in your court. If you're ever going to finally be consistently profitable, and as a short-term trader or a long-term trader, you need to include a process of managing your mental and emotional capabilities. Now, I use the word capabilities, not weaknesses. You are capable, but something in the past has created neural pathways, neural nets that have that when you're asked to make a move by your trading plan, you resist, you hesitate. I'm going to talk about that a little bit. I'm going to first ask you one question. Well, I also want to say I might as well read that line right there that says, if you're not willing to change to manage your mental and emotional capacity, 2020's results are just going to keep repeating themselves, like 2019, 2018, I'm sure in 2017 have. Okay, so here's my question. This is the only question I'm going to ask you to put in the chat so that I can zoom in this last part of the conversation. What is your primary thought or emotion that has you trade in a way that compromises or hampers your trading success? What is it that you do when you trade that's screwing you up, that's having you make mistakes, that's moving stops around? What is it? Can you just throw it in the chat and let me see if I can pick it up here with some of the, are we doing in the questions? One of the questions? Either one, just throw it in there. Fear. Fear. Patience. Patience is a big one. Nice to hear reality. Scared to lose. Fear of continued losses. Yes, that's a big one. We have two, and we've separated that, incidentally. Levesque, we've separated that from overcoming the fear of losing to overcoming losses. It's two different things. If you can overcome a loss immediately, then you overcome the fear. Then the fear of losing doesn't happen. So we kind of treat that separately. But let's get into it. Okay, now I can see where I need to concentrate on. Thank you so much for giving me some direction here. Okay, so you have a decision here. You're either going to go on the same path that you have for the last few years, or you're going to take, I'm going to call it the path on the right. I think the right path, if you're with me this long, and I'm not showing you charts and big markets to buy, I think you realize the importance of what I'm saying, because this is the key. This is the key between struggle and success. And I'm counting on you having at least a decent trading plan. Even a good trading plan will make you money if you can run it. A very good trading plan, an excellent trading plan, can make you a lot of money if you have the mental and emotional capability to run it. So what am I offering you? What is, and this is something new, okay? It's something new. I've done it on an experimental basis with several of my better clients, and they have loved it. So I'm making it official. And this is the first time I'm presenting it. So if you've seen me present before, you haven't seen this. It's called Excel. And we use Excel because it's a term that we use when we're coaching athletes. They want to excel. And I want to show you what that means. We call it a trader transformation in just 35 days. Now, we go for long-term coaching, a year at a time. We're there when you need us, kind of thing. And Tisha said to me, you know, people want change right now. And I think you're missing a lot of people who appreciate the mental and emotional concerns, and they need to turn those around. But by offering them a year of coaching or whatever, and you'll be there for them no matter what happens, and that's a good thing. And I suggest that you consider that if that sounds great to you. It's another talk. But what about those who want to make dramatic change in a short period of time for the things that they can identify that's really hurting them? What if we did that? That's why we put this together. It's a 35-day trader transformation, okay? And here's the way we've laid it out. It's 6 weekly meetings. They're going to start on January 10th. You'll sign up today because we've got a super early bird that I'm just giving to people here today. 6 weekly meetings, okay, and it is starts on Tuesday. I'm sorry, on Monday, January 10th, and every Monday for 6 Mondays. It's a total of 6 Mondays. Okay. Then between those meetings, let me go back. The 6 meetings, in those meetings, they'll be not 60 or 90 minutes long. And in those meetings, you'll download a worksheet where we'll go through one particular situation, like pulling the trigger without hesitation or fear of losing. We're going to handle one specific major thing each of the weeks. And there's a worksheet that will work through how you identify with that particular situation. And then we'll share ideas. Okay, we may even break into, you know how they do it, we'll be doing it on Zoom, and if the group is large enough, we can move into different and work other processes separately. But understand that it's a working meeting, that we're going to dig in to really, the more clear we are on your specific situation, the more we can help you overcome it quickly. Okay, so the 6 meetings are working meetings that you're going to get a lot done, and you're going to get all the clarity that you need in each meeting. Then between those meetings, okay, you're going to work with our proven assets. And I'm going to demonstrate what those are in a second. There's subconscious trainings. They're an Eastern technique that we've used, and other techniques that I haven't talked about in the past. We're using everything. We're opening up our game play, our game book of processes that we know can get you behavioral change. We're the best at doing this. We're the only one, I think, do it, especially specifically for traders. So 6 weekly meetings, work with our proven assets between meetings, and then there is the accountability, and this stands alone. You'll have access to us by email. Anybody who joins this, you'll have a private email for access if there's any questions in between. But also, we'll actually be able to see if you do your homework or not. And when I say homework, I mean a 7-minute meditation, some of the things that we're going to assign you to do between meetings that'll take you 10 or 15 minutes a day. But we want to make you, you need to be accountable. And I'm not saying you're a weak person if you're not accountable. That's why I love coaches. I love coaches, and I've avoided the word coach here. Yes, we're kind of coaches here, but it's more than that. I used to fly. I paid somebody $20,000 a year for 4 or 5 years in a row to coach me in how to run, how to grow my business. I'd fly up to Toronto once a quarter, and we'd all sit in a room. It wasn't for an hour and a half like these meetings are. It was for a full day, and we did the processes. This is where I learned some of the processes that we're going to be going through in these weekly meetings. All I'm saying, it was worth every penny of it because I was accountable to somebody. You're going to be accountable, okay? So let me give you a little bit of the detail behind each one of these circles, okay? The 6 weekly meetings. 6 weekly meetings. They're on Mondays beginning January 10th. Okay, they're going to be at 5 p.m. Eastern time, each meeting. Now, I did that because it's the best time to serve everybody around the world. It's 10 p.m. in London, it's 6 a.m. in Singapore, it's 9 a.m. in Melbourne. The only ones I couldn't are Indian clients and people in the time frame. It's very hard. But this is the most common time frame where everybody can be there live, and but everything will be recorded, so you'll be okay. You can see the recording. It's always best to be there live, but you can go through the recording. And also with these meetings, I mentioned a worksheet. We're going to have a worksheet for each of the meetings that are going to work through exercises that I learned in the coaching that I just mentioned to you. That I was doing for several years. I learned how he did it and why it was so darn effective for me running a business. I've made that, I've shifted that, just tweaked it so it can do the same thing for us as traders and help us to meet this 35-day deadline of being totally transformed from a trader out of control with their mentality and in control to run it and stop making mistakes. Okay, so the first week we're going to do this is not It really depends. I'm going to be polling those who join about some of the orders and what's most important to you. So those people who join, that's why I want you to join today. I'll be polling you, and based on all the polling I'll be doing up till January 10th, I'm going to put these in the order of most important to everybody. Will be covered eventually. But hey, if most people are telling me that their main problem is hesitating to pull the trigger and they're afraid for certain reasons, I'm going to make that the first week. Or maybe it's going to be lack of patience. Or maybe it's going to be revenge trading. I hear that a lot. Or maybe it's going to be fear of losing. Whatever it is, we've got 6 weeks to work through all of these things. This is, you can tell I'm excited about it because this really works. It really works, and I want you to be part of it. I don't want you to continue to have losing year. It doesn't have to happen. Okay, and again, everything is recorded if you can't make the meetings. Okay, and when I say work our proven assets between meetings, this is a picture of the subconscious mind. Okay, it's a pretty good picture. It's an actual picture. I'm going to call it subconscious mind. What it is a neural net. It really is those. If you see the little worms here, these little tendrils, these are actually energy. This is actually thought energy. You can call it. And when you have the thought that that if you take the next trade, you'll only lose because you just lost 4 trades in a row. That's this. And then if you do it again and again and again, and if you say the same thing to yourself and enough times, it's going to build a neural net. This will be what's right for you. This is going to be part of you. And this way, when your trading plan gives you the stimulus to take a trade, what's right for you is hesitating to take the trade because you've convinced yourself of that through building these thought energy processes. The way to unwind that is to get into a meditative state, which is just a few, and I'm not talking about a tinfoil hat. I'm talking about proven things that you just take a few deep breaths, relax, and listen to a 7 to 10 minute meditation that we've made specifically for traders. And it's not, I like myself. It's, I am a successful trader, and I understand that my stops are important to whatever it is, I understand that hesitating to take, that when my trading plan gives me a signal, gives me the impetus to take a trade, I take it without hesitation. I understand that over the course of time, winning trades and losing trades are part of the overall winning perspective. I understand I'm a wise and disciplined trader, and I do the things that a wise and disciplined trader does. If you put enough of the positive feedback into your mind, and this is, again, this is science, you'll build a neural net that serves you, that will take trades immediately upon the trading plan giving you the stimulus, and this neural net will shrink, and the new neural net will become the new you. We're going to help you do that. We also use something called EFT. EFT is the go-to therapy for separating thought from emotion. It's the go-to therapy for military men and women who come back with post-traumatic stress disorder. It is now the go-to therapy. It works. It helps to separate thought from emotion. And I am not comparing the importance or the trauma of war with the trauma of trading, but there is trauma in trading enough to consider it important enough to use the same quick therapy. And when I talk this therapy can be performed in literally 5 minutes. And we have videos that you'll watch between, and we may do, Tisha, I'm sure we'll do 1 or 2 live in our group, but we also recorded these where you follow along with Tisha, repeating what she says and working with points on your body, the Eastern energy points. I know it may sound strange to some of you, but meditation and Eastern philosophy has been proven to work miracles, literally. I mean, it wouldn't be the go-to therapy for post-traumatic stress disorder. And you can look that up, EFT poster. We have it all for you, ready to go specifically for traders, okay? And then there's the accountability. That's again, I've repeated that a few times here in this circle because I can't stress how important it is for you to know that we're there for you, but for you to also know that we're there to make sure that you do the work. We're not going to pound you and insult you, but we're going to ask you if you did the work, and you're going to have to be honest with us. And that's just a nudging. We're going to nudge you, And that's what part of what you're paying us for. That's what I paid $20,000 for 4 meetings, because I didn't want to go back there every quarter and not do the work. This will work for even the most stubborn trader who has lost year after year and believes that maybe this is not for them. If you still believe you have it, join me in this, okay? Again, 6 weekly meetings. We're going to get together on Zoom. It's going to look like this, okay? Some of you are going to not show me your face, but I wish you would. The more you're exposed to the group, the better. I really want those who are willing to share and be themselves. Don't even have to shave if you're a man. Don't have to comb your hair if you're a man or a woman. You can just, I'm going to come unshaven sometimes, because I want this to be real. I want this to be deep, and I don't want you to be hesitant to come to the meetings live. Again, they're recorded, okay? And at the meetings, you'll have your worksheet. We'll work on it together. I'll take a 5-minute break as we're all working, and then we'll go and review what we've written. We're going to ask for volunteers, etc. So this is really intense. Okay, it's intensive and it works, but because it gets the job done. Between the meetings, we're going to give you access to our assets, the subconscious trainings that we're famous for, and the EFT sessions that is now the same sessions that are mandatory, or the go-to therapy now for emotional, for the stress disorder for service people. And then, of course, there's the accountability. So you see it all here in one foul swoop. Okay, and so I want you to be part of what we're doing. Adam said, I can barely believe how my trading is transformed. I feel calm and in control every day throughout my trading session. I'm following my rules consistently after years of repeating the same mistakes over and over again, and all the stress and anxiety that I've always associated with drawing have disappeared. With trading have disappeared. This is withdrawing. Yeah? It's really unbelievable, he said. And it's all thanks to the things Norman and Tisha taught me about the subconscious mind and the subconscious mind training sessions. I can't recommend the coaching highly enough, okay? And MJ, who was the first one to send us statements like this, Norman and Tisha have the tools, experience, wisdom, and heart to move traders from stuck to unstuck. Their coaching targets the very next hurdle to help you move forward quickly. If you're struggling, do this. Thank you, MJ. I know you're probably on this call. She's on a lot of our calls. So will this be another year of frustration and money drain? Are you ready to reverse the fear of losing that causes you to hesitate and miss trades that would have been profitable, and start taking trades with confidence? Are you ready to start exercising patience and waiting for your entry setup to complete, instead of jumping the gun on trades and seeing the market reverse, causing losses that never should have happened? And are you ready to stop revenge trading? Are you ready to stop moving stops around because you don't want to get hit only to suffer much deeper losses? Are you ready to get out of your own way when you trade and become the profitable trader that you know that you can be? Then I want you to commit to taking 35 days starting January 10th and excelling. I want you to join Excel, and here's the link to do it. TheDisciplineTrader.com. Oh, I'm sorry. Yeah, no wonder it wasn't working. It's got to be TheDisciplineTrader.com. I want you to put that, if you write it for me properly in there. I was so excited I didn't put it in there specifically correctly there. TheDisciplineTrader.com. If you click on this, you won't get there. TheDisciplineTrader.com/Excel. Thank you very much. It's in the chat right there. And I haven't mentioned the price. It's $9.97. The early bird price, though, for the first 25, this is the first presentation I'm making on it, is $497. And because I have been impressed, and because Anna took too much time off between these presentations, I think it was 2 or 3 months. I don't know what you were doing. You're probably resting from all the work that you do all year long. But because this is Anna's show, the Investor Expo price today only, $397. $397. And I'm not going to, well, I can put it up, but remember to put TheDisciplineTrader.com/Excel. It's in the chat right there. And I think we may have one or two. No, we have no time left. So there it is for you. I'm hoping that you take advantage of it today. and it's today only $397. Join me. Let's get this done. Let's not have another year that you'll regret. Let's start winning. Thank you, and stay around for AJ, because AJ won't tell you that this guy, AJ, respects risk more than anybody else. He won't tell you that because he won't tell you that he is actually the man on the flying trapeze. AJ flies through the air. I'm serious. As a professional, literally professional quality on the trapeze, throwing himself from trapeze, with people catching him. He does this. He won't tell you this, but he does this because he understands the value of excelling and the value of risk. If you take risk properly, if you understand risk and you defend against risk, and nobody knows that like AJ. So stick around because he's got some good things to say. All right, AJ, there you go.
Thank you, Norman. Very good. And by the way, Norman's program is one of those programs you guys should consider because it's a program that I did back in the day. I'm talking about almost 20 years ago, and I still use to this day the techniques that he taught me 20 years ago. So Norman's been around for a while and he's had success for a while, and there's a reason. And so consider that program. But yeah, Norman mentioned that I have decided to, in the last 6 years, to run away and join the circus. I mean, it only took me into my late 40s to be able to do that, but it's because of investing and it's because of selling options. And that's what we're going to be talking about today. And so maybe you're going to get your dream lifestyle where you can now run away and join the circus. Or maybe that's not your dream. Maybe you don't want to be on the flying trapeze. Maybe you want something else. Maybe you want to pay off debt. Maybe you want to have the dream house or the dream yacht or something like that. Investing not only gives you the resources to be able to do that, but investing also gives you the time if you invest right. So let's talk about the behind the scenes look at how I create a 7-figure income selling options, and how you can too. I was just going to say, let's get into the meat of this presentation. I've got a couple of facts for you. There's a lot of uncertainty with what is happening in the world right now. All right. So what I was saying is what's happening in the markets right now, if played correctly, it can set you up for months, if not years to come. Now, stay tuned, folks. I'm going to show you some live examples. So I want you to be prepared to check that out. But in the meantime, I want you to remember one key fact, and that is money is not or created or destroyed in the markets, right? We always hear talking heads. I just heard some folks on CNBC even this morning talking about how many trillions can get erased, but it's not true. What happens is money simply moves from one person's hand to another. So it's really important that you put yourself on the correct side of the transaction. And that's what I try to do all the time. Let's go through some pieces. Now, before I even do that, I would like to know kind of a idea of who I've got on the line here. So I'd like you to just type into the chat area. I've got the chat area, the Q&A area up here in front of me. Are you here, or what would be ideal for you if you were to learn how to invest for low risk and high return, basically learning how to fish, be 100% self-reliant? Or do you want to learn how to invest and have some sort of seasoned investors reviewing your investments before you make them? In other words, you want to learn how to fish, but you want to have expert fishermen on the same boat with you. Or do you want to follow what seasoned investors do in their own portfolio? In other words, you're not really interested in learning how to sit down and do all the fishing yourself. You'd rather fish alongside expert fishermen and just copy what they do. Or maybe you've got something else on your mind. But if you could give me an idea where you personally, if you took inventory on yourself, where do you fall on this? All right. All right. That's interesting. Okay. Well, I'll try to tailor this presentation because this presentation's got a lot of knowledge, but I'll tailor this presentation to just about everybody. A couple of you are saying D, so I'll try my best on that one, but I know I can succeed on making this presentation for those who put A, B, or C. So let me start with something very simple. Now, you've probably seen this a bunch of times in your life, but just humor me here. If I was to give you $50,000 right now, today, for no work, or give you a penny that doubles every day for a month, which would you take? And by the way, the penny that doubles every day for a month, in order to make that penny double every day for a month, you're going to have to do some activities. You're going to have to be an active investor. Which one would you take? The $50,000 or the penny? Let's go through the math. So if you start with the penny, then by the end of the first week, you've got a whopping 64 cents. Now, remember, you've been putting in the effort to double that penny, and after 1 week, about, a week is about 1/4 of a month, you've got 64 cents, and you're starting to think to yourself, maybe I should have taken the big wad of $50,000. But let's keep going. All right, day 8, day 9, day 10, we're up to $5.12. Still, you'd have to make that 1,000 times more, 10,000 times more to get to $50,000. So we're almost a third of the way through the month, and we're asking ourselves, did we make the right decision? All right, now we're 2 weeks into the month. We still don't have anywhere near $50,000. And we've been wondering if all this work we've been doing every day to invest this penny has been worth it, because we're almost, at this point, 15 days, we're about halfway through the month, and we're nowhere near the $50,000. But let's keep going. All right, I'm 3 weeks, almost 3/4, almost all of the month, 75%, a little bit under 75% of the month is gone. I'm starting to see some figures, but still, I'd have to get 5 times this amount in order to be above the $50,000. All right, day 24. We're almost done with our month, and we finally have over $50,000. We have $83,886.08. And if we keep going, it's these last few days of the month that actually turn us into a 21 millionaire, $21,474,836.48. And as you know, that's something called compound interest. And I'm not sure if Albert Einstein actually can be attributed with this quote, but everybody does. Compound interest is the most powerful force in the universe. But I want to remind you that it wasn't, you had to put a certain amount of effort, and you weren't seeing any of the results for almost 24 out of 31 days, right? And that happens to be, when I look at investors, that happens to be something I see often, is that folks want something called instant gratification with their investing. And they're not willing to put in the effort to not only learn, but then to let their money work for them to get to those last 6 or 7 days, or that last, 20% of the time, to really make the money. They've already moved on to the next shiny object. So keep that in mind. I want to show you this picture here. I'm going to come back to this picture, but I'm going to pull up my marker here because I want you to notice that these two lines, number one, go up exponentially, and number two, that even the gray line, which is the lower line, the gray line comes above this break-even line right after 1, close to 2, and then from there on, the numbers start to get very big. I want to kind of tattoo this picture into your mind. And I also want you to tell you that if you reverse engineer, now we're not going to be talking about doubling a penny every day. I mean, there are times when you can double your money in the markets, but those are far and few between. I want to talk about something more realistic, such as doubling our money every year, right? And if you reverse engineer that, just with simple, not even compound interest, if you earn 6% on your money every month, if you focus on 6%, if you aim for that moon and then possibly go buy it and shoot for the stars, but if your moon is 6%, then you will more than double your money every year. So what I like to teach my folks to do when they're investing is focus on getting more than 6% on your portfolio every month. That means that if you start with a $1,000 portfolio, then in 12 months, you're going to have $2,012. In 2 years, you're going to have $4,048. 5 years, you're going to have close to $33,000. And in 10 years, you're going to be a bona fide millionaire. But even more, if you grow your portfolio to about $100,000, then that means your portfolio is going to become that golden goose that lays golden eggs, and it's going to generate about $101,219.65 per year. Now, the interesting part about that is if you look at the mean salary in the United States for a 60-hour-a-week job, it's $87,000. Now, I'm not talking about you folks that live on either the left side or the right side of the country. Obviously, if you live in those big cities, it's a lot more, but the mean salaried position is $87,000, and you can expect to work between 50 and 60 hours per week. Here, you're letting your money work for you, and it's generating more than that mean income. You can move wherever you want. You can go join the circus and fly on the trapeze. The potentials are unbelievable. So let's talk about how we're actually going to do this. What are we actually investing in? Well, we're selling faded decay optimized option premium. Now, what the frick does that mean? Basically, we're profiting on time passing by. So let me just ask a review question here. What minimum returns did I say you must make monthly on your portfolio to more than double your money annually? Is it A, 0.5%, B, 1.5%, C, 5%, is it D, 6%, or is it E, 10%? Which one is it? Go ahead and type it in to the Q&A area. Give you a few more seconds. Quite a few of you are getting it right. The answer is 6%. Please make sure you're taking notes, by the way. I do tend to talk a little bit quickly, so please make sure you've got a paper and a pencil or pen if you're feeling very confident, and let's take some notes. So write down 6%. Now, aren't options risky, right? Because people are always talking about, well, think about anything that you trade on the markets, or think about anything you trade, right? We make money if the price goes up, right? If we're normal traders, we have one strategy. We buy something. We buy stocks. We buy commodities. We buy indexes. We buy crypto. We buy foreign exchange currencies. We buy classic cars. We buy real estate. We buy paintings. We buy baseball cards. And we hope that the price goes up. That's one strategy. Now, the other thing that some folks do in the markets with commodities and stocks and indexes especially is they can short, right? They can make money if the price goes down. They basically borrow some of the asset, sell it, and then buy it back at a lower price and keep the difference. So two strategies, right? Stock traders, commodity traders, they have basically two strategies. Well, option traders actually have 27 different ways they can make money on a pattern. So not only if the underlying symbol goes up or down, but also if it goes sideways. Options, because of their expiration date, we call them decaying assets, can actually make money as time passes by. In fact, options can make money if there is fear and uncertainty or confidence in the market. There's just so many ways. Options give you that flexibility to take any pattern you're looking at and figure out a way to profit on it. And also, options give you the ability to do some leverage in some cases. But what is an option, right? Well, it's a financial instrument called a derivative. We always hear that, financial instrument called a derivative. But what are options really used for? Well, typically they're bought and sold to hedge risk, right? Stocks are optionable. Many indexes, ETFs are optionable. Of course, that's not how we use them here at Trading Trainer. What we're doing is we're selling their premium, and that generates an ongoing income for us, right? This is the main bread and butter of our portfolios. And then we take small portion of our portfolios and we do the more exciting and interesting stuff that, requires you to be glued to your computer. But when you don't want to do that, this is just paying you month in, month out, or if you're doing weekly options, week in and week out. By the way, let me take, first of all, let me ask this. Please just type into the Q&A area. How many of you actually know who I am? Can you just say yes or no? I just want to get an idea, because I can bypass this little bit here about who I am if there's a lot of people who already know me. Couple of yeses, but mostly, well, this will be very quick. I've been around for, well, as long as Norman has. I mean, I started Trading Trainer in 2003, and I've been doing option trading since 1997. I mean, you can go on YouTube, you can go on Spotify or Apple iTunes or Google Play and listen to my podcast. I've got a Facebook page, Twitter, articles that you can go to, white papers. You could just call us, right? I founded this company called Trading Trainer, and a lot of the investors out there call me the world's most disciplined options trader. Now, I think behind my back, they actually call me, well, I think they call me the laziest options trader. And the reason why I like to think of myself as the most efficient option trader, and the reason why I think they do that is because I'm very good at getting from point A to point B in my investment portfolio, not only with the least amount of initial investment, but also with the least amount of time investment. I do not like to sit in front of the computer. In fact, I can't. I can't sit in front of the computer. It drives me bonkers. And I've got better things to do. I've taken up a new career, as Norman mentioned, kind of surprisingly. I like to perform in the circus. So I'm not somebody who can stay in front of the computer all day and all night, right? And I don't think many of you do. I mean, the last time I held a job was in 2005 when I worked for Hewlett Packard. And the last thing I wanted to do when I left that is ever have to work 9 to 5 again, right? And some of you can identify that. So I'm very, very efficient because I don't like to use any more time or money than I have to get my desired results. And I also don't like to waste my emotions because, as Norman said, you can have, and a lot of traders do, you can have emotions of complete celebration when things go right, but you could also have emotions of complete despair to the point where I've heard traders who want to end it all, right? Because things went against them. I don't want any of those ups and downs in my life. In fact, my wife and I just had a newborn on October 31st. And so even at the, and my joke is I'm changing her diapers now because I mentioned I'm 48 years old. I'm changing her diapers now so that it's just in time for her to start changing my diapers when she's of age. The scoop is the last thing I want to do is have ups and downs. I got plenty, staying up with this little one that's 6.5 weeks old. So with that said, that's why I consider myself the most efficient options trader. Been doing this since 1997, publishing stuff for Trading Trainers since 2002, wildly successful ebook called The 7 Strategies of Successful Option Traders. You've probably seen on many people's computers. You might see this in a lot of successful investors' bookcases. My home study course, it's been out for over, 14 years now. And the big thing that I like to be known for is the foundation I started, where I take historically underserved inner city kids off the street and teach them how to invest. I started this in Denver with 9 investors back in 2003, and I taught these kids. And what's neat is some of you are like, I could never do this. And the truth is these kids didn't even have access to computers. We had to go to the public library. And back then, the public library, all they had was something called a DSL connection. Do you guys remember a DSL connection? And they would give us only 45 minutes a day on the machines. And so we had to figure out how to sell premium on the library machines in just 45 minutes. So if these kids who had no more, even though they were high school, I fully believe that the public school system failed them. Most of them had less than a fourth grade, 10-year-old education. And not only did they all succeed, but at the end of the 6 months, and I thought I was just writing this off, I gave them each $2,000. I was like, I'll never see that money again. Each one of them paid me back. In fact, one of them has been teaching finance now. They're all grown, has been teaching finance at Denver University. Another one, all of them went on to like buy themselves their own computers and be able to do this at home. It's just a huge success story. And we've been running this every year. We since have moved this to the south side of Chicago. And we've been running, the last time we ran this program in Chicago, we had over 180 graduates. So this is what I really like to spend my time on, in addition to my athletic prowess. Okay, now that you know a little bit about me, how do we sell this option premium? Please get your pencils ready or pens. We focus on 4 simple transactions. Write this down. We write covered calls. We write covered puts. That's flipping the covered call upside down, so we make money when things go either sideways or down instead of up. We write covered calls against leaps. Basically, we supercharge our covered call writing, and for you academics out there, this is a variant of a bull call diagonal debit spread. And we write covered puts against leaps. Again, supercharging the covered put writing, and this is a bear put diagonal debit spread for you academics out there. Now, the scoop is I want you to take special notes on this part particularly. These 3, writing covered calls against leaps, and writing covered puts against leaps, are cash trades, and you can actually do them in your retirement accounts, right? The Roths and the traditional IRAs or the SEP plans or the 401ks. These are things you can do here, whereas the covered puts, because you do have to short the underlying symbol to get this trade started, it requires a margin account. So keep that in mind. I'd like you to mark that on your notes. So some of you are saying you keep mentioning this thing called option premium. What the heck is option premium? Well, if you look at an options price, and an option is traded on the exchange just like stocks are, you can actually split it up into 2 components. It's in the money value, otherwise known as the intrinsic value, and it's premium value, otherwise known as the extrinsic value. The premium value, some people call it the time value, which is the biggest misnomer because there's a lot more in it than time. So that's my pet peeve. I don't call it the time value. I always call it the premium value. And if you take these 2 things and add them together, you're going to get the option price. Okay. So let's figure out how we can sell. These are some prices from Ford from this past weekend when I updated this slide set for you guys. Ford at the end of close this weekend was $21.45 per share. So what if we buy some shares of Ford and then automatically sell back the Ford January 21st, 2022 $22 call? That expires in about 4.5 weeks from now. We would get $1.10. That means we'd get something called an instant dividend for $1.10. And we would make $110 per option in lots of 100. So that's kind of cool. We get this instant dividend. Guess what? That also acts like a coupon. It acts like a coupon because as time passes by, and let me go ahead and make sure you can still see my presentation. My presentation keeps moving screens on me. I apologize for my computer issues today. There we go. So $1.10 is the money we make back. It acts like an expiring coupon. It actually acts as like a discount on the stock as well. All right, so let's go through the scenarios. What happens if Ford closes above $22 on January 21st? So we paid $21.45 for Ford. We're going to get exercised or called out of our Ford stock. And the person who does that, the one who bought our call option, is going to give us $22 per share. So for every share, we're going to make 55 cents of profit. We also get to keep that $1.10 from selling the premium. Overall, we walk away with $1.65 of total profit. That comes out to about 8.1% ROI. That's nice. That's over our 6% target. But let's keep going. This is actually the ideal case. What if Ford continues to move flat? And on January 21st, it's only gone sideways. Okay, so we bought this Ford stock for $21.45. We got the $1.10 discount. We got the $1.10 instant dividend. And so we get to keep that $1.10. It expires worthless. And we've made 5.4% ROI so far, and we also still have the Ford stock. So we're going to do it again next month, and we're going to do it again and again and again. And for those people who are doing weekly options, you could do it every week if you wanted. Now here's the big one. What if Ford drops by January 21? Now I want you to stay tuned a little bit later in the presentation, not much later, but a couple minutes from now. I'm going to show you how to reduce your risk on reward to almost nothing, but even built into the covered call strategy by itself, if we bought that Ford for $21.45 and we sell back that $1.10, we've actually created a profit buffer for ourselves for $1.10. That means that Ford would have to drop over $1.10 for us to even think about being in the red. We have a break-even price of $20.35. Now again, stay tuned. I'm going to show you how we can even reduce the risk further. But inherent in this design, not only do we get the instant dividend, we get the discount on the security. It acts like an expiring coupon, but we get this profit buffer. Now, before I go on any further, I actually want to show you an actual trade. So let me pull up my trade log. This is a trade on Huntington Bank that I did. And I do also have my Thinkorswim open, so I can show you Huntington Bank. I have the S&P 500 up right now. But Huntington Bank, it's basically a symbol that kind of goes up and down, but stays in a range. Those are the ones I like, by the way, boring stocks that stay in a range. I bought 700 shares back on October 14th. A couple days later, on October 26th, I sold 7 contracts. I got 75 cents per share on each one of those options. November 19 rolls around, and the option, I get to keep the 75 cents, and I get exercised out of the stock for $16. And so just in that small amount of time, from October 14th to November 19th, I walked away with an easy 5.2% ROI, depending on how you calculate it. I always like to calculate ROIC on initial. So 5.2% ROI, not bad for only doing one transactions. These transactions on November 19th happened automatically, right? At the end of the day, I went into my portfolio and I saw that I had all this extra cash. It was like a payday. All I did was one transaction on the 14th, another transaction 12 days later on the 26th, and I wind up with 5.2% ROI. So I want to show you that's just as easy as it is, right? All right, let me make sure you guys are paying attention. Just type this into the Q&A. Answer all that apply. What does investing by selling premium create? Does it create an instant dividend, a discount on a security, a profit buffer, an expiring coupon? You can answer a couple of them, all of them, one of them. What are the answers? A, B, C, and D. All right, people are replying. The answer is absolutely all of these. Make sure you circle all these in your notes. Couple of returns. Now I want to speed this up a little bit because with all my screen troubles, I've been a little bit behind. But here are some of the returns: 17% on Micron in 12 trading days, 15% on Activision in 34 trading days. This is when the underlying symbol went sideways. 14% on all scripts when the stock took a big dookie. So now I'm going to ask you a question. Things are going to get a little bit more complicated as we go forward. But now I want to ask you a question to see if maybe you already know the answer. How can we lower our investment, increase our returns, and even convert a margin trade into a cash trade? Should we sell some out-in-time options? B, should we replace the security with some options trading at parity? C, should we give up and buy mutual funds? Or is D, what we're talking about is not even possible? What do you think? A, B, C, or D? Yeah, I'll give you a couple more seconds. What do you think? All right. If you said B, replace the security with an option trading at parity, pat yourself on the back. If not, stay tuned. You might be saying to yourself, okay, that's an interesting answer, but I don't know what options trading at parity are. Well, realize this. Option premium is the most when options are at the money. That's why when we sell near-term options at the money, that's why we do it, because their premium is the most. But when we want to make a substitute, we go deep enough in the money, and then the option has very little premium. In fact, we target less than 5%, and it's almost completely intrinsic value. Now, you might be saying, wow, that's way over my head. What are you trying to say there? A deep in the money option behaves exactly like the underlying security, dollar for dollar, meaning if the underlying security goes from $100 to $101, the deep in the money option could go from $30 to $31. They move dollar for dollar, but the substitute's at a cheaper price. And you might say, okay, I'll go deep in the money, but these options have expiration dates. How far out in time should an option expire? Well, most of our positions last on average 5 months. That means we're collecting our income from them every month for about 5 months. Now that's an average, it's a bell curve. Some of them last as many as 8 months, some last as little as 3 months, but on average, they're 5 months. So what we like to do is we go out as far out in time as possible so we don't interfere with selling as many cycles of premium as we can. So what does that mean? We go at least 8 months out. Okay. Now, 8 months from, say, for instance, right now, December 16th would put us somewhere in August of next year. A lot of times we'll go ahead and go even farther out to the leap. That means the options that expire in January of 2023, 2022, 2024. We use the leap just because of liquidity. Those leaps have been around for a while, and there's a lot of options trader already using them. So typically we use option leaps, but not necessarily. The main rule is, and this is what I want you to write down, is you go at least 8 months out. So let's actually go through the Ford example again. So Ford at this weekend was trading for $21.45. I could substitute that with the Ford September 16th, 2022 $12 call. That's more than 8 months out. And it's only going for $9.70. It's going for less than half the price. And if you look at this particular option and you look at the intrinsic versus extrinsic value component, the intrinsic is over 97.4% of its value. The premium is just under 2.6%. So this is pretty much moving dollar for dollar. So, okay, if we substitute and we only pay $9.70 for that back month option, And then we do the same thing we did before. We sell that front month option. We're going to get our instant dividend of $1.10. We're going to get the discount against the back month option. We're going to get the asset that acts as an expiring coupon, but only this time it's on a $9.70 initial purchase instead of $21.45. So what happens again if Ford closes above $22? Well, we spent $9.70. And this time when we get exercised, we get $10. That's because we get exercised at $22 and the broker automatically exercises this other one for us at $12 and we keep the difference. The difference between $22 and $12 is $10. So we get $10, which gives us a 30-cent per share spread, our profit. In addition, we get to keep the initial $1.10 that we made by selling the front month option, giving us a total of $1.40. $1.40 on the initial investment comes out to 16.3% ROI. That's way, remember I said aim for the moon at 6%? This is 16.3%. That's why most of the people who are participants in my program, instead of doubling their portfolio every year, they double it every 5 months. Now, what happens if Ford is flat by January 21? All right. Spend the $9.70 on the back month option, get the $1.10 for selling the front month option, keep the $1.10 when the front month option expires worthless. We've made 12.8% ROI on our investment. This is the ideal case, by the way. And we're going to do it again and again and again. And as I mentioned, these trades typically last 5 months, but sometimes more, sometimes less, could go as many as 8. I actually have one right now that's been going on for 15 months. Now, what if Ford drops? Same thing. There's a profit buffer of $1.10 built in. Ford would have to drop by $1.10 for us to even think about being in the red. The break-even price on this is $8.60. So cool. I want to remind you. Actually, before I remind you of anything, I have a trade. That was kind of a theoretical using Ford's prices, but how about this real trade we did on Pulte Home? They make houses. They're like they make neighborhoods and houses. So okay, on October 28th, we bought 6 contracts at $19.30 of these Pulte Home. Here's the leap. January 2023, $30 calls. So we bought 6 of those. Then on November 10th, almost 2 weeks later, we sold the Pulte November 19th $51 calls. Then we just wait. We waited until November 19th when those options expired. The options expired. I got to keep the dollar per share. I also got exercised. Now, I got exercised at 51, and so I did some exercising at 30, which means the broker deposited the difference between $51 and $30, $21 into my account for a ROI for just a few days between October 28th and November 19th of 13.8%. You can't go wrong with this, folks. All right, so let's remind you, if you earn 6% on your money every month, then your investments will more than double every year. If you do better than that, they double faster. Like I said, people in my program tend to do this every 4 to 5, sometimes 6 months, depending on what's going on. Some more returns, 21 when the stock traded up, 12% when the stock went sideways, 17% when the stock went down. So now here's the third piece of the puzzle. See how many of you are paying attention. It's getting a little bit more involved. How can we drastically reduce our return on risk? What should we do? Should we sell half as much option premium? Should we sell out in time options? Should we collar the investment by marrying a protective option, or is what I'm talking about not even possible? It's a crack, it's something like a crack pipe thing. You know, you're like, you're out to lunch, AJ. What do you think? A, B, C, or D? If you said to yourself, let's collar the investment by marrying a protective option, that's exactly what we do. So let me actually show you a couple of examples of that, because somebody was asking me on one of my YouTube shows, they were asking me about Delta Airlines. Now, Delta Airlines, we had a trade that we had placed on it, and then it dropped. I think it dropped after earnings. It dropped 2%, and the person was asking me, they were like, AJ, how did you fare on that trade? Well, actually, I fared amazingly. Let's go through it. So on November 3rd, I bought 4 contracts of the back month option on Delta Airlines. In fact, I even have this written out. So let me show you this. This is easier for you to see. It's the same thing that's on this spreadsheet, but it's much easier to see. So on the morning of November 3rd, I bought contracts of Delta Airline, $15 calls expiring in January 2023. And I spent $26 and a penny for each option share. I placed a stop loss order on Delta going below 37. So if Delta went below $37, I'd be protected from any sort of risk. I always do that. I always place a risk stop. And then I waited. That's sometimes the hardest part. On the afternoon of November 10th, I then sold. Now, this is 7 days later. I sold to open the contracts of the Delta November 19th, $43 calls for $1.38. At the same time, I bought some Delta March 38 puts for $1.47. These are my protection. Okay, then what did I do? I waited. So I did one transaction on November 3rd. On November 10th, I did these 2 transactions. At the end of trading on November 19th, this is when the option expired. I didn't do anything. This happened automatically. My Delta front month call options, they expired worthless. So I got to keep all that money and I didn't have to do anything. That just happened. So now I've got the Delta back month option and I've still got the protective put. On the morning of November 26th, those back month options, Delta went below $37 and I got stopped out. And on those back month options, I made $22. I didn't do anything. The stopping out happened automatically. I just came back at the end of the day and said, oh, I got cashed out because Delta went down below 37. But I still have my protective put option. In fact, I waited, and when the protective put, when Delta seemed to have been at its lowest point, when the put was at its highest price on the morning of December 2nd, I went ahead and sold the Delta March $38 puts. I made $5.65. So in other words, I did what? Some transactions on November 3rd, 1 transaction on November 3rd, 2 transactions on November 10th, and 1 transaction on December 2nd. Delta Airlines fell as much as 3% during that time, and I walked away with 5.8% ROI. That's because I make money on time going by, and I use my protective options to protect myself in these particular situations, right? Our front month option premium expiring worthless and our back month options getting stopped out all happened automatically. When all was said and done, we made 4 trades on 3 different days spread out between November 3rd and December 2nd, walked away with 5.8% ROIC despite Delta gapping down. Now, I like to emphasize that because a lot of people are like, what happens if the stock goes against you? You make money because you've set up the option strategy appropriately. Does that make sense? I hope I'm piquing some of your interests. Take a look at this trade on PAAS. This trade has been going on for forever. I still have positions open in it, and it started back in August. But here's what I want to point out. Listen, on August 26th, back a year ago, over a year ago, I bought shares, 600 shares for $34.73 of this stock, Pan American Silver. And then a couple days later on September 1st, I sold premium for $1.76 a share, and I bought protection for $4.75. Now you might say, why are you spending so much on protection? Well, check it out. When that option expired on September 18th, I got to keep the $1.76. And when I rolled out my protective option, when I didn't need it anymore, I got to sell it for more than it was worth, just like in the Delta Airlines. I sold it for $5.90. So not only did I make $1.76, but I also made $1.15 on rolling out my option. It's like frosting on the cake. Now, a lot of folks, when they're talking about protecting options, they're talking about protecting your trades at a loss. Like, I'm going to buy this insurance, and that's a loss leader. Not here at Trading Trainer. What we do is we select the options appropriately and roll them out appropriately so that we actually have a profit center, not a cost center. So notice, just after that first month, my cost basis per share is down to $31.86. Where's my protective put? $34. Think about that. What happens when your break-even price is below what you're insuring your trade for? Think about that. Because we did it again. The next month, $1.47 we sold in premium. We paid $3.01 for our protection. The premium expired worthless, and when we rolled out our protection, we sold what we bought for $3.01 for $3.62. In other words, the insurance policy we bought, we used it for that whole time, but when we sold it, we got more money than we spent on it. We did it again, $1.50, $1.20. When we sold the insurance back, we got $3.07. Month after month after month. Think about that, folks. It's pretty awesome to think about. So that PAAS, that's in this graph. In fact, I wish it could go even further than 7 months. These are months down here. This is the break-even price. This is the average time our investments last, 5 months. And so what I want you to notice is if the position got exercised in 5 months, we'd still be talking about 65% ROI. If this position had the underlying going against us, like we saw in Delta Airlines, we'd still be making money, right? Because at this point, even having the underlying go against us, the gray line, it gets to a point, the more months that you hold these positions, it gets to a point where who cares if the underlying goes in our direction or against us? The returns in either way are stellar, right? This is why it's difficult for some traders to do this, because the key is you have to wait. You have to let time work, because the longer you let the time work, the more this position will make for you. And notice right here, this red line I just drew right here, this red line is where we are no longer below the break-even price. That's how long before this position becomes risk-free. That means no more of your portfolio is even on the line. So what do we have when our cost basis or break-even price is less than our protective bailout price? What do you think? Do you have something called a risk-free investment? Do you have a losing trade? Do you have too much complexity? Or do you have a pipe dream? What is it, A, B, C, or D? Absolutely. So not only are these trades effortless, and they just put income in your pocket every time options expire. If you use the monthly, it's every third Friday. And for those of you that do sell options, guess what tomorrow is? Third Friday of December. Payday. Not only do we make money there, but we also have very few investments in our portfolio that have any risk associated with them at this point. So let's review it, because I'm just about done. I've already gone over my time, so I have to wrap this up. I've been talking your ear off here. We're going to buy or short an underlying security, or even better, we're going to buy a substitute option trading at parity. That's step 1. Step 2, you're going to sell a near-term at-the-money option for its premium value. You're going to collect your instant dividend and set up your profit buffer. And finally, step 3, we're going to collared with a married option that is about 3 to 6 months out in expiration to protect your investment, and then you're going to rinse and repeat, rinse and repeat. Here's an example of timing. A lot of people ask me about timing. So if you've got your sideways boring symbols like the one we've got on a screen, when we're towards the bottom of the channel, that's when we're going to buy our underlying stock, or we're going to buy a call option substitute trading at parity, and we're going to put a stop loss in place, just like I did on Delta Airlines. When it's near the top, we're going to sell the near-term call option, buy the 3 to 6 month out put option as protection. That near-term call option expires whenever the expiration date is. I typically use the monthly options, but I know plenty of people in our program who use weekly options. And then towards the bottom, we're going to sell back the 3 to 6 month out put option. And then you're going to, like I said, rinse and repeat, rinse and repeat. But what if you come into this trade and instead of being at the bottom, do you have to wait for it to get to the next bottom? No. We could also do the covered put or the covered put variant. So we can either short an underlying stock. If we come into this and see this symbol and it's at the top of the channel, we'll short the underlying stock, or even better, buy a put option trading at parity. Then we're going to put in place our bailout, a buy to close order triggered above. We're going to wait till it gets to the next reversal. Doesn't have to be perfectly at the bottom. In fact, we rarely are. We're going to sell our near-term put option. We're going to buy a 3 to 6 month out call option as protection. Of course, our put option expires on the expiration date, and our call option, we're going to sell it back and roll it to the next one at the next reversal, and we're going to rinse and repeat. So whether you're at the top or the bottom of the channel starting this, one of those 4 strategies is going to work. All right. By the way, before I go any further, let me just ask you to type in, how many of you have actually learned something today? Awesome, awesome, awesome. Well, how would you like to never miss one of these underlying symbols? Minimize the amount you spend away from your loved ones or whatever is your passion, or have support whenever you need it. Because that's really what it's all about. It's all about saving time in doing this. It's all about creating clarity in doing this and getting the results that you're looking for, right? So would it be okay if I take just a couple of moments to tell you a little bit about my materials, my training, and my tools, just to see if they're right for you? And I'll condense this because I realize we're over our time. Thanks. This is for someone who doesn't want to pay for a bunch of data subscriptions. They want everything they need in one place. They don't want to miss any opportunities. They want to spend more time doing other things. They don't want to be doing this all by themselves, and they want step-by-step instructions. In other words, this is for someone who wants to get consistent and reliable results. Charlene, just very quick, she did my program, but she came to me, she wrote this very early in the morning one day. She'd been a teacher, one of the most undervalued professions that I could think of, and I'm sad about that because all of our little ones are going to be going through school. She was a teacher for 29 years and she got sick. She didn't write it here, but she got cancer. And she was ordered out of the classroom because she just couldn't do it with all the different treatments. She still had 13 years left to get her pension. She thought she was going to pass away and she was totally peaceful about it. And then she had a miraculous recovery. Now, only here in the States, well, I'm not sure. I'm sure there's other places in the world, but here in the States, this is where getting recovered from a deadly disease sucks, because she was socked with a ton of medical bills, right? She had no livable retirement coming in, and she wasn't going to be able to collect her Social Security check for 10 more years. She got interested in the stock market. The rest is history. Thanks to AJ, she's not only going to make a living, she's going to start traveling, which she actually already has been traveling. She has this instant income calendar program and the scanner tool that comes with it. She reads the daily table, finds the stock she's interested in, and follows the strategy. She used this along with other strategies to diversify her financial plan. She recently made 14% by just spending about 15 minutes reading about the company, following the chart, and then waiting for expiration, right? So that's kind of does this resonate with you? All right, really quick, I'm going to show you this. Boop, 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 boop. See if we can get here. I'm going to show you inside our member portal. This is what the members have access to, right? And so you can see we have these weekly workshops every Thursday evening. We have one coming up tonight at 6 p.m. Pacific time, right? We even have these monthly workshops that come every once a month that are lecture series. And all of these workshops, whether they be the lecture series or the workshops, have replays. And what's really nice is the workshops are interactive. Right now we have about 400 folks registered in our program, and on any Thursday night we have over 100 people who come live. And we go through and we pick a symbol from our screener. We have access, as you can see right here under Trading Tools, we have access to this screener. And folks bring their screened candidates to the interactive workshop, and we pick the best of the best, right? By the way, write this symbol down, CLF. That's one that we're really following closely these days. Go check it out on your own time. We take these symbols, and not only do we look at them, we actually plan out the trades. And as you can see here, when I take a look at the replay, we provide the plans so that folks can go back. Not only do we provide the replay, we provide a written transcript of the replay, and we provide the actual plan so people can go back and do it themselves. I'm clicking here, and there it is. We provide all the plan. We give everybody a special tool that I created. This is a tool for planning. You fill in the blanks, and it creates these plans. You can see here, here's your plan for writing a covered call. It tells you exactly what to do. Here's your plan for writing the covered put. Here's your plan for buying the bull call diagonal debit spread. Here's the plan for buying a bear put diagonal debit spread. So everything is written out for you. And we do these together so that everybody can go off and follow these plans. It's pretty awesome. Not only do we have the weekly workshops and the monthly lecture series, but we have video tutorials to get started. We have the screeners, and then we also have, because between every Thursday, some folks create their own plans on different tickers, or they personalize the plans because they have a different size portfolio. You can actually send those plans to me, and I ask for people too, through our special messaging system, and I'll review your plan and send it back to you with feedback. So I personally will look over your shoulder to make sure you're doing this right. So the question I have for you is, with the video tutorials, the monthly live classes, the lecture series and their replays, all the screeners, there's actually 3 of them, the planning tools like this tool here, which completely plans out your trades and gives you the instruction, including the number of contracts and shares to buy, the weekly live workshops and their replays, the trade review that I personally will do. What's that worth to you? But wait, I have a double your money back guarantee. So I want you to work with me for 6 months. I want you to be part of this program for 6 full months. And if you do that and you don't show a profit, now, of course, I'm not going to cover you if you go do your own thing. I ask you to fill out a trade log. But if you're not making a profit by the end of the 6 months, if you're not profiting, not only will I give you the money you pay for the course, the 6-month course, I'll double it. That's how confident I am that you will be profitable selling option premium the way that I teach you. Also, I'm going to give you a strategy session with one of my coaches. Now, this is a bonus just for the Investor Expos folks, but you know where you want to be and you know where you are right now. So you're going to take one session with one of my coaches. Usually this costs a fortune. And you're going to talk about A to B, and they're going to tell you, this is what you have to do over the 6 months in order to get from where you are right now to where you want to be. So take all that stuff, add in the double your money back guarantee and the bonus strategy session. What is that all worth to you? Give me when I'm asking you what it's all worth to you. I have a little bit. We'll get back on track. Let's make sure you guys can still hear me. Yep. All right. All right. So this is the price. It's $597 for 6 months of working with me directly, getting my screeners, getting all the stuff that was on that list. And there's no other charges. You have access to all the different data feeds, 6 months of the program. And of course, because it's been a while that I've been with the Investors Expos folks, I'm going to give you a deal for today. Actually, it'll be a deal for this week. Instead of $597, I want to reduce it by $100 for you guys only. So I'm going to give you a special link. I'm going to reduce it down to $497, flat fee, 6 months of program. Here's what you have to do. You have to go to optioninvesting.org/Investors Expo. I don't know why that says Traders Corner. I apologize. That's not what it should say. I changed it. Let's come over here. There it is. Go right now to optioninvesting.org Investor Expo. And so what you should see when you get there is something like this. I have the order form. I put in the web address here. And I think that if we look at the chat section, it's in the chat section too. You'll get this. Make sure you put that promo code right here, 100 disc. That's just for you guys, 100 disc, and click apply, and it'll reduce it by $100. You could also call us on the telephone if that's too difficult. If you have your mobile phone, you can scan the QR code right off the screen. Don't pass go. Don't collect $200 because you deserve this. And that brings me to the end of my presentation. I don't see any questions in the Q&A area. I've already gone over quite a lot. So Anna, I have to thank you very much.
Thank you so much, AJ.
You're welcome. That was awesome.